We are back.
We are back.
Beautiful. So I've been waiting for this segment for like a year since we started the show. I'm Tom. She's Vanetta. He's Tony. And
he has told me about you for years. For years and years.
Well, so let me introduce Karen. And the only reason I'm not giving out last names is because I just don't want people reaching out to her, because I know respecting your privacy, and also because
you want to keep it for yourself. We got it. It's not a big deal. Listen, I understand.
Thank you.
You're welcome.
But I'm the one that's excited to be here.
Beautiful.
I mean, wow, this is very impressive.
Well, I mean, we have known each other indirectly for probably 10 years, meaning that she knew me before I knew her. And it wasn't until some point about 3-4 years ago where somebody said to me, "Hey, who is this woman?" Okay,
And why hadn't she run yet?
No, and look at the risk that she has on, that kind of thing. And we're like, okay, we better figure out who this person is. So let me tell you the story, because this is great. And thank you so much for coming in. And this is a story I've been wanting to do for a ridiculous amount of time. And you fill in the blanks for us.
Well, I'm learning a lot. I didn't know you looked at what we were doing.
We don't until it pops up on a radar screen.
Okay.
And the funny thing in the brokerage business is we really don't. People think like, oh, we look at individual accounts, but what most brokers do is they just do a scan. They have risk monitors, and they do a scan, at different points, different standard deviation move to figure out where the risk kicks in. And for big traders, everybody pops up. I used to pop up every day. For about 20 straight years. So it happens.
Get called into the principal's office when you're a market maker, and they understand what you have on here. You short a couple of units. You familiar with that? Yeah, I understand the concept.
I'll buy some units.
Right.
So Karen, your story is amazing, and it's inspiring, and we have tens of thousands of listeners that they're dying to hear this. So I'm going to start off right at the beginning. And you correct me if I got anything wrong, just so I can fill people in. You were the either CFO, accountant for a small business, and you guys were brick, right? It was
brick and mining.
Brick and mining.
Brick and mining.
Nothing to do with the financial side.
No.
And I always have this saying. I have this crazy saying, which is, next thing you know, you're 50. Okay, which means most people, Karen, they start.
So we're going to talk about your age now, Karen.
Okay.
As we're going with this. I'm glad you're going to be here about 20 minutes.
Like I said, weight's off limit. But we talk about my age.
People like. One of my pet peeves is that nobody gets involved investing when they're young, and they go through. They spend 10 years, 20 years, whatever it is, and next thing you know, they wake up and they're like, "Wow, I've accumulated some money, but I don't really know what to do with it." And so Karen's a perfect story. She's worked for 20 years. You have multiple degrees, and you're same business for the whole time, and all of a sudden it's about the year 2000, and if I get the story right, your money's being managed by an advisor at Merrill, and let's just say around $100,000 to be fair. And she has some liquid assets outside of that. She attends a preview. One of her friends drags her to a preview for Investals.
Yes.
That's pretty fair, right?
That's correct.
And you went kicking and screaming.
And are you crazy? Why would we want to do this? But also, just around that time, I remember someone saying, no one is ever going to manage your money and watch your money as well as you are. So that rang true to me, because over the years, I'd go up, go down. My asset value would increase, decrease. And I didn't feel like I was making any progress. So she and I had talked about trying to do something in business together. So we went to a free Invest Tools seminar, and in that seminar they were offering what they call a PhD program, and it was $22,000.
$22,000.
Yes, and she said, "Oh, let's do this," and I said, "Are you crazy?" But she talked me into it, and together we took that PhD program that took about a year and a half to complete.
So you walk into a seminar blind in 2002. Now remember, 2002, investor education was really in its infancy. I mean, there was Investals, there was a couple other companies, but it was pretty much in its infancy. And the topic, as far as derivatives go, even though they were probably an upsell further down the road, it was pretty much about fundamentals and buying stock, selling stock, and basic technical analysis, right?
Covered calls, just all the basics. How to read a graph, how to do analysis, phase 1, phase 2 analysis, looking at a balance sheet, looking at an income statement, how to read what a MACD was. What
green and red arrows.
Green. All you had to do was look for 3 green arrows or 3 red arrows, and you were going to be rich.
Yeah, but it all starts out in the beginning. Remember, this is the wonderful thing about what Investo's, and I know people think it's because I've been thinking about this for the years. It changed the face of online investing and individual. It changed the face of self-directed investors because although in the end, the curriculum had to be changed and things had to be tweaked and things like that. It engaged people. Like you never would have got engaged if you didn't hear some great preview speaker. And they're probably whoever the speaker was probably a wonderful speaker.
Wonderful.
And they engaged you, and they got you to thinking. And now you're a smart person. You figured it out from Now it took a number of years. So let's fast forward now to 2000. Let's go. You said it took about a year and a half to 2 years.
Yes, and I'm really a 10-year overnight success because it took a lot of work. It took a lot of study. It took a lot of doing things incorrectly. But what that program did was it opened doors. It piqued my curiosity to want to learn more. I tried a whole variety of strategies. I thought I was going to be a real technical trader because I have an accounting and math background. So I had 12 or 14 charts I was following in technical analysis. And I did that for a few years and had some successes and more failures than success. But I learned from the failures. That's the important thing, is not to give up, not to look at, I have failed at this. I can't do this. No, what you've done is gotten closer to a success, because every time I failed, I learned something that made me a better trader and a better trader and a better trader that got me to where I am today.
So you were a little bit of a numbers junkie on your own before this.
Yes.
And then so the business made sense to you, but putting it all together and learning how to make money, that was really difficult.
It was difficult, but if you persevere, it took a lot of time. I see people getting into this thinking it's going to be quick and easy, and it's not quick and easy. It's difficult. It takes time. You have to study it. It's like learning a craft. You have to know the ins and outs. You have to practice, paper trade, do whatever you have to do. Every time something goes wrong, analyze it. Why? What did I do wrong? What can I do better the next time? And it took years, but that built on itself and built a real solid foundation.
So 2002, you opened your first account at Toss.
Yes.
And with $10,000, if I remember.
Yes.
$10,000. And so now I'm going to fast forward to 2007. 5 years. And this is Karen working. I mean, I'm assuming you were a seminar junkie too. You went to a lot of classes.
A lot of classes.
Both Invest Tools and Option Planet classes. And because I know you had heard me speak.
You still working a full-time job then too?
Yes.
So, I mean, you're taking a lot of time, but you're still working a full-time job.
Full-time job.
Well, she was committed to making this work.
Trading at lunch, trading at night.
I know, but I just want to make the point that you didn't just sit in front of a computer for 5 years. You actually had a job that you had to do too.
Yes.
Okay.
So we're gonna take that $10,000 account. We're gonna fast forward to 2007, and at some point in 2007, I don't know how much money was left in the $10,000 account, but in 2007, a light bulb goes off.
Yes.
And the light bulb, something clicked inside of you, and you said, "Okay, now I'm going to take my $100,000 that's being managed somewhere else," which is probably still about $100,000.
Yes, it was.
So in 5 years, the professional manager had given you your money back,
yes.
pretty much.
Pretty much.
You moved it into your trading account, which is a big step up because I'm assuming that's pretty much everything you'd saved over X period of time that was liquid.
Everything that was liquid.
Right.
Yeah.
And you decided to give it a go.
I did. I felt like I was getting into some other areas of my life, and I felt like I could at least make a living off trading. So I retired from my company and decided I would do this to earn a living so that I could go do other things, pursue other things I wanted to do in my life.
This is a bold move because at that point, even though a light bulb went off, you had never there was no proof of concept, meaning that you had never earned a living doing it before.
No, that is correct. I often say I went to the deep end of the pool and I jumped because I had a confidence level, though, that had built up over all of that training time and all the practice and the study and work, all the mistakes I had made. I had a decent confidence level that I could make this work.
So here's where the story gets amazing. So from 2007, you move the money over, and now you've got the 100,000, let's just say approximately, and you start trading. And at this point, you've also changed your trading style a little bit. You're confident because you're focusing more on strategies than you are on anything else, and you're believing in a little bit different approach, the short volatility, some short premium, and you turn the $100,000. And remember, 2007 was the year that volatility got annihilated down to like 10%. 2007 was the summer of 2008 is when the market kind of topped out, and so from 2007 to 2008, you turn your 100,000 into 150,000.
150,000.
Okay, so it's a 50% return, and you support yourself.
Yes, and I've moved into options at that point. Decide stocks are just too difficult to pick. No matter how much work you do, there's such a good chance you're going to be wrong. And moving,
we say it's about 50%.
It's about 50%. and moving more in the direction of non-directional plays. Really starting to tap into that. Realizing if I buy a call, I only make money if the market goes up. And I only make money if it goes up a certain percentage because you have to cover the time value loss.
The break-even point, right.
So that's got to be a better way than this. So that was just starting to evolve at that point.
So all of it clicks. So let's just say some point in early 2008. Now remember, 2008, the end of 2008 is the economic meltdown. It's the debacle in the markets. It's the worst time ever to be short premium and to start getting involved in this. So, but your proof of concept works, and you go from 100 to 150,000. People that you're friends with are watching you. They decide, hey, you know what? I really like what you're doing, and they also come on board with you. So you raise a little bit of money, intentionally, non-intentionally, whatever it is, and you build your account size up to more than a few $100,000. Let's say in the total, you start with like in 2008, maybe $600,000 or $700,000.
Right.
And so here's the amazing story, because I'm going to fast forward now.
Okay.
I'm going to fast forward through all the market crash, the economic meltdown, blah, blah, blah. We go all the way to 2011, and somehow between 2008, because this is the remarkable piece of the story, to 2011, you make $41 million.
Correct.
How are you not a Lifetime movie? I would watch this. This is amazing.
Okay, so and I skipped through 3 years of time, but Tony and I have done this for, at this point, by the same years you're talking about, a lot of years. We're in our mid-20s of doing this, and we've seen a lot of the greatest traders in the world, and but on a professional level. I had never seen a customer before have the kind of, now at the same time you raised additional capital came in, so you went from essentially 100,000 to 700,000 to about 80 some odd million with money that they raised and things like that.
Right.
But 40 million of it are profits.
Yes. Wow.
And in a period of time where I think it was a difficult market, I don't think it was a difficult market. It was a difficult market. Period.
The worst.
So what the hell happened? Like, I mean, Karen, and we watched it kind of from the sidelines because you were a customer, and when I say we watched it, we would monitor risk like we do every customer. We weren't watching what you do, but you were a phenom. And you weren't exactly like, what I'm saying is most phenoms are, they're 18-year-old phenoms being drafted out of high school.
Or they're 50 pounds heavier than you. And
whatever it is. You don't fit the prototypical
But I got a few phone calls from you where you said, are you sure you're watching this? Yes, we're watching this.
I have a very high tolerance for risk, and you were a bigger man than I was many times. That's all I'm going to say. But Karen, because people are wondering, how did you do it? That's what people want to know. How did you do it?
Well, a couple of things. First of all, like I said earlier, really stopped trading stocks. That got us out of the guessing game of, is it going to go up, is it going to go down, and got us out of the earnings season. I really like when we stopped playing the earnings game. We got strictly into options, options in stocks, slowly moved over to the indexes. As we moved over to the indexes, then we could play more safely, and then we started strictly shorting indexes.
Shorting premium.
Shorting premium, shorting premium.
Okay.
So as we've built this strategy, it's a very simple strategy. So one area that's improved what we've done is gotten simpler and simpler and simpler. We gave up a lot of the technical studies. We watch price and volume are our two main items. We have Bollinger Bands on our charts, but we watch the charts, we watch the movement, and we trade very short. And we're very nimble. So we work off theta, and we're just in and out of the market within about 56 days is about as long as we'll venture out. And we keep pulling that in shorter and shorter and turning these things around, but doing it in a very conservative way, trying to stay safe in all of our positions. My philosophy is once you give me the money, you're not getting it back. So once that premium comes in, we have strategies in place where we do not give the money back. So very rarely, one of the things that makes us successful is the way we manage the account. We rarely lose in a position. Right? It's a rare thing that we lose in a position.
Now, when you say that, because you're just playing, it's a straight probability game. So you're going outside, like to what level? Because we teach a lot of different, when we're doing short premium, more like the way you trade, which is kind of wide index triangles, right? That would be the closest, like if we were plotting it, that would be what it looks like on a plot. You told me yesterday, you stick to three different indexes primarily, the S&Ps,
SPX, RUT, and NDX.
Okay, so the three largest, and you have. I'm guessing that your tendency is to go how far. What is to get to the break-even point or to get to the probability of expiring inside the number? Is it 80%, 75%, 85%? Like you're inside of what level?
We're working more of in the now it's called probability of being in the money.
Right.
Around 5%. We're putting
so
positions
you're
on
at the
around 5%.
2 standard deviation move. Okay, so you're basically at a 2 standard deviation move going out about 60 days.
At the most.
At the most, 56 days or whatever you said. So you're at the far ends. You're at the far ends of the curve. You're essentially the same place where the brokerage firms are at. You know, when we monitor risk. So you've been doing this now. So you've had some. Let's talk about some of the market moves during that period. I mean, remember. Early 2009 was hairy. And then you had the flash crash.
Flash crash in 2010.
Which was May 6th of 2010, which had to be nerve-wracking for you guys.
It was very nerve-wracking. I was practicing my Spanish that day because I thought I would be moving to Mexico very soon. Fortunately, we survived that.
And so you've had some... I mean, it's not like you haven't been tested. In fairness, you've been tested.
Yes, we've been strongly tested.
But I looked at your performance, and the number of drawdowns is very much consistent with your probability of success. And I think that that's the hardest thing for individual investors to really understand is if you go out, let's say to that 95% chance of going in the money, which is the inverse of that is your probability of success. And if you look at your drawdowns are amazingly consistent with that probability of success. So you're talking somewhere between 5 and 10% of the time you'll have a drawdown, which based on your schedule, you're probably talking about 1 to 2 drawdowns a year, which is consistent with your strategy. And it's amazing how those numbers play out.
Work.
Yeah,
they always work.
It's last year we have 2 funds. One fund had 0 drawdowns, and the other one had 1.
That's consistent with the probabilities you're going to. Now, one of the things that you're probably starting to discover now is that the more money you make, the harder it's to make money.
We're not quite there yet.
Yeah, you're close.
I've thought about it. I've thought about it. We're still at the point where, as the money flows in, we're still successful just increasing the number of contracts that we trade in a position. So it hasn't become difficult.
It's amazing how liquid the markets are, aren't they?
It is.
I mean,
so let me ask you, because this is so it's. I wish it wasn't as rare as it is. Like, I wish your story I wish we could have 1,000 people in here with a similar story. And there's no reason that we can't. Right. Because but I think there's a couple takeaways from this that are so exciting for us. One is that you're proof that anybody can do this, which is awesome. And I mean, I'm not saying it like, I'm not trying to make this into, I'm not trying to say what you did isn't amazing, but you are proof that anybody can do this.
Yes.
And you don't have to be, I mean, we started when Tony was 20 years old. I mean, I was 22 or whatever, or he was 19. I was 22. We had nothing to lose. You were in a very different position because if this didn't work, I mean, it's not as easy to recover when you're not 21 or 22 years old. And then the other piece to it is the hard work that it took. Like, it really paid off. It was unbelievable. But were you confident all along that this is what was going to happen?
No, this has been an amazing surprise. But through those years, it took a lot of discipline. I came home every day after work and would sit down and apply like at least 1 hour of just concentrated study. I did that night after night after night. So that's what I see the most of is people that get involved in this think it's going to be easy and it's going to be quick, and it's not. But if you're dedicated and study and practice and learn your craft, there is a great payoff down the road. That is something I've learned over time is to be patient and really work on the emotional process, because greed and fear are very strong emotional activators in this, and it'll make you do stupid things. Mm-hmm. So you really need to build the confidence and rely on that confidence and look at what you're dealing with as, how am I going to manage this? Not the, oh my word, the market's falling. Okay, the market's falling. How can I take advantage of this? What happened with me is I stepped back and started seeing the big picture. I got my mind out of the minutia and reading charts and ticking this off and ticking that off, and just pulled back and said, how can I manage this looking at the big picture? What is this telling me? And I simplified it, and the more I simplified it and the more I looked at the big picture, the more successful we were.
Preach the same thing. I wish this show was around then, because we would have shortened your time frame. But it's crazy how, like, you probably thought it was the worst $22,000 you ever spent. And I mean, and she went to North Carolina and Wake Forest. I mean, she has for graduate degree. I mean, you probably thought it was the worst $22,000 ever. And then in the end, that level of engagement, what got you excited, that first preview speaker, whatever it is, kind of, this is what happens. That's why there's so much value in engagement, and you can't discount that. No,
and I've got $22,000 invested in this now. I'm going to make the most of that. But it's just blossomed into so much more, and I've learned so much through this process. You can do this. It just takes patience, and it takes diligence, and it takes a lot of effort.
So as a final wrap up here, Karen is now become a money manager, and you're.
Do you have an account at Merrill Lynch or anything like that? Do you ever speak to that gentleman that you used to have your account with?
No, he's with me now. He's one of my investors.
Awesome.
You know what, Tom? That just about says it all.
That makes me teary eyed.
I love it when it comes full circle. I really do.
Did he call? Was he on his knees saying, "Karen, can you manage my money, please"?
Pretty much.
I love it.
Hey, you're managing about $160 million, something like that?
Yes.
And between the two funds, she's made about $56 million over that same period of time, which is just, listen, I mean, I know a lot of hedge fund managers and blah, 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 and I've watched a lot of movies and seen a lot of ups and downs. And I mean, you're doing it the old-fashioned way. There's no inside. Mm-hmm. She has no edge here. This is not Morgan Stanley desk, or JP Morgan's trade desk trading against their own flow. This is you just doing it in the retail marketplace. You're a customer.
That's right. And our group's grown. We've got 6 people, including me now.
That's
and
awesome.
It's just great. It's the greatest job I've ever had in my life.
It's the best story. I'm ending it right there. It's the best story ever. Thank you so much, and you are welcome here. open door whenever you want to come in here.
Well, I'll be back.
We'll be back in 90 seconds. Thank you, Karen, for your time. You're listening to Tasty on the Tasty Trade Network. Thomas, I guess we're back. I mean, I'm back, but you're new.
For the 30th time, we are back today, and I am so excited to be here. By the way, that was awesome.
Yes.
To the teams here at TastyTrade, it was awesome.
It's nice to know when we're in this room doing the
Stuff's
the
going
work,
on.
stuff
Stuff's
is
happening.
actually happening, yes.
Just before we start the next segment, just a quick little, because I did kick Beth out, and you're right, that was a pretty good trade for you.
That was a great trade.
Probably the best trade you made in a couple of weeks.
The best one of the night, for sure. I can give you that one.
One of the things that we're having fun while we're trying to change financial literacy among our younger generation, and it's a challenge. But I don't want to make it seem like we're taking it on because we love it, and we wish that we had been this proactive and aggressive with our kids and everything else. So one of the things we did is we went to TD, who's our partner in this, our marketing partner, and we went to TD and we essentially said, you know what, if we could get an interesting way for kids to participate with their parents and with their grandparents and through a uniform gift to minors account, which is a UGMA account. If you would waive all the fees, then kids could really start growing with one share of stock at a time, 1, 2, 3 shares of stock, just something like, for example, if you wanted to buy Disney, I don't even know what Disney's trading for now, let's say $40, and you wanted to buy 2 shares of Disney, normally it's cost prohibitive because of commissions and everything else. But TD agreed for 1 trade a week into perpetuity here to waive the commissions. And so if you come through our link, which supports TastyTrade, new accounts are our lifeblood. And if you come through that link and you open up a new account for your kids through the UMGA account link, it's just, not only does it support everything we're doing here, it also is a great way to build value and over time to compound real portfolio returns and understanding. Builds financial literacy. It's special, and I compliment them for jumping on board and for understanding that, and for our creative teams here for doing something that's awesome.
It's a win-win.
It's a win-win. So Tony, we are here. We are a pre-debate night, and we have, as we have infamously called her, Karen the SuperTrader.
It says it right.
Hello.
It says it up there.
It says
it's a
it right
special
there on the
guest.
screen. It says Karen SuperTrader.
I don't know who made that up, but it's intimidating.
You're very embarrassed by that.
We called him Sauce Grande in the pit, and he's able to live up to it. You can live up to Karen the SuperTrader.
Well, I'll try not to.
We did not make up the term Karen the SuperTrader, just so you know. No. We had the first interview with you, and we posted the archive, and somebody said, you have to watch Karen the SuperTrader, and it just caught on. It stuck virally. So I blame all of our listeners for that.
Okay, that's
or Tony, whichever one's worse.
Whichever one's closest.
So Karen, we're going to move. A lot of people have watched our last interview with you, and I thought it was incredibly inspirational within this little industry space, within this little sector. And I thought, and I'm not going to rehash a lot of the last interview, but I think there's a bunch of new people on tonight, and we just need to just set a basis for where we're coming from. Then we're going to get into 1,000 questions that we have. We've been logging questions from our listeners and our members for months now. But just what's so fascinating about your story is, and I'm not, we said age is okay, no weight, right?
That's right.
I'm the same way.
No, actually, we're the opposite way. What am I saying? Our age limit? We're not saying our weight. No.
So in your early 50s, around 50, 52, let's say, you decided one day to take an Investools class.
Yes.
And I'm fast forwarding a little bit. You decided to take an Investools class, and you signed up for their PhD program, and you went through, back in 2002, and you went through the whole thing, and it took you a couple of years. And again, we're talking about a professional woman. You were a CFO of a small private company, and you had saved you collected a reasonable amount of wealth over the years, and you're now deciding, okay, next thing you know, I'm 50. I'm going to go through the process. I'm going to learn about investing my own capital, and then just take us through to 2007. Fast forward us through 2002 to 2007.
Well, you're right, and thank you for bringing me back, and hello to Tony. it's been an amazing ride since last May when we spoke. And I decided ultimately I wanted to be able to invest my own money. I thought no one is going to take as much concern over my money as I am going to. So having a math background and an accounting background, I really decided I think I could do this and started taking classes. My friend Jill and I took seminars all over the United States. We just educated ourselves, and it started there. And I thought, someday I'll retire and I will invest my own money, and that's how I'll keep funds flowing in to my bank account. So we fast forward to 2007, and by that time, I decided to resign from my company, a company that I loved, a career that I loved. But I do believe that we all have an innate desire in us to live a life of significance, and I was at that point in my life, and that means many things to many people. But I decided to start a public charity, a 501c3, and devote the rest of my life to working in that area, working in international work, mainly developing countries, and that I would live off of my investments. So I started that in 2007, and then in 2008, a man I'd known through business for many, many years approached me about managing some of his money. And that's when it takes off.
So
that's
let me
when it
just
explodes.
So we went from 2002 to 2007, and there was in 2007 you started with, let's say, about $100,000 of your own capital, and you had come up with a trading methodology that that included a lot of credit spreads and things like credit spreads and two-sided credit spreads like iron condors.
Correct.
And over the course of from 2007 to 2008, before you raised any outside capital or you got any additional funding, you made about how much money?
I raised the $100,000. I was trading to about $150,000.
Okay, so basically, you made $50,000 on $100,000. This was your first real venture into this. Now you have to understand a couple things. Karen started on the ThinkOrSwim platform, and that's it. And now what we're going to show you is a few $100 million later, she's still on the ThinkOrSwim platform with nothing else.
That's correct.
So the platform was scalable, huh?
Yes. And
But what about you? How did you go from like your own money and to did you go out and look for the funds? Did they find you? Like, did you go from, okay, like I'm gonna make this money and I'm gonna live on it? How did you ramp it up? I mean, I understand the platform can do it.
If someone told me that I was going to be here 5-6 years ago, I would have said, you're out of your mind.
Sure.
This was not planned. It was because the person who approached me about managing his money, he had known me for 20 years. And we talked about the market, and he said, if you're making that kind of return, I'm not making that anywhere else where I'm investing. Please manage some of my money for me. And I made the comment, losing my money is one thing. Losing your money is a whole different thing. And that I really did not want to take on that responsibility. But over a few months, he convinced me to start with a small amount of money. We started with $600,000. And that opened up
Okay, so again, I'm going to set the stage for the discussions we're going to have for the next 45 minutes. Okay. We start with going to a class in 2002. We ramp it up to $100,000 of her own capital, which she turns into $150,000, and then she raises, not intentionally raising, but somebody else said, hey, you know what? Why don't you manage my money along with yours? Is originally how it started. So you end up with $750,000, $800,000, some number like that, which is a significant amount of capital.
Sure.
But the amazing part of the story, this is just the beginning. So we're in 2008. Now, you remember what happened in the end of 2008. We went through a meltdown. And from the beginning of 2009, okay, and these are just some crazy statistics. You started to have some amazing results.
Yes.
And people were essentially just kind of throwing money at you. It seems like. I mean, I know I don't want to sound that crude, but it was almost like, wow, something special is going on here, and we want to be involved, more like it. So over the next couple of years, and I don't want to get into all the specifics, you essentially built up two funds.
Yes.
One fund that started in 2008 that raised in total, $42 million.
Yes.
And you turned that $42 million over time with all the different, with all the different returns and everything else into a total of $95 million. Now, people can say, hey, that's just a mediocre return. I promise you, I've been around for a long time. This is not a linear business, okay? It is not linear. And Karen, what that means, Karen, is like somebody can turn $10,000 into $20,000.
Or $50,000.
And $50,000 into $100,000. I've been in 30 years just buried in this business, and not too many people have turned $42 million into $95 million. But that's just Fund A. Fund B, over time, you started a second fund with $1.3 million, and you ramped that second fund up in total, to, if I just want to make sure I have the numbers all correct, but you ramped that fund up to about 20, there was a total of about 27 million initially invested in the second fund, of which you turned to 42 million. And then on the 42 million, you ramped that up, you raised a few more dollars, another 25 million or so, and you turned that into 95 million, to a total of 95 million. So you went from this crazy idea that, okay, I can trade with $100,000. I mean, and listen, you're as we call it, common folk.
I'm common folk.
You're common folk.
Common folk.
So $100,000, and in the end, you're managing 190 million.
That's correct.
Of which 105 million, almost. I'm ballparking it. Of which $105 million are trading profits. And I don't care who you are. And I've been around S&P 500 traders my entire career. And I can promise you, if I got a room full of 300 SPX traders and grabbed them out of the pit and said, do you know there's a retail customer out there trading on the ThinkOrSwim platform that's made $105 million in your pit, and you don't even have any idea that she even exists? They'd be like, you're out of your mind. Tony?
100%, no doubt.
They would say, they would bet.
They wouldn't believe you.
They would bet both pinkies on that one. Okay? So it's a phenomenal, I know you're going to downplay it, but it's a phenomenal story. And I think the driver behind it is the simplicity. Talk to us about how simple you keep your methodology and how simple your approach is.
I first wanted to say the reason for the second fund was the profits from that fund, the net profits from that fund, all go into the charity. So it's created a very unique way of raising money.
So you're
for
a better
charity.
person than us, too.
If you've ever tried to raise money, it is a tough job to be in. So this has been a blessing all the way around. So what was the question?
It's about simplicity.
Simplicity.
Because Karen,
it's not as easy as it looks in this room, is it?
It isn't. It isn't.
Karen, I think Tony and I both felt since we started the show that the if we cut out all the noise and a lot of kind of the ideas that this is so complex, and talk to us about the simplicity of how you created your business and how you make money with just a very simple approach.
Yeah, we have moved from 2008 to 2012 from a very complex environment to a simple environment. And I said in last May's show, the simpler we've made it, the better our return has been. It takes the noise out of it. You can effectively trade on watching very few technical analysis, watching very few charts, simplifying just the range that you trade in. And we have two funds sitting there. If we tried to make this very complex, we could get into trouble very quickly. So by keeping it simple, everybody in the room knows the game. Everybody knows what we're doing. There are no questions. We know where we want to trade. We know how much we want to trade. We know when to stop trading. So one of our powerful strategies is to keep this all simple and to keep it narrowed basically and a few indexes.
Okay, so let's talk about that. So you told me earlier today, you told Tony and myself that a light bulb went off kind of late 2009-ish, okay, going into 2010. And prior to that, you had traded mostly iron condors and credit spreads.
Right.
And starting, which you did amazing doing that, but starting in 2009, late 2009, 2010, you started to get more into what we would call some naked positions and some naked strangles, things like that. Can you talk to us about, first, we'll start off with the products that you trade up to today, the products that you trade today.
From the products I traded originally.
That's right.
We traded, I mean, there were times we had 30 stocks going as far as options. We've always been in options. And we were trading in iron condors, but we would leg into them. But basically, we followed about 30 stocks. And then we started whittling that down to about 10. Found that was so much easier to do, so much simpler. And then little by little, we got burned a couple of times on earnings. And I know you have some special strategies for earnings. But trading the way we traded, we got burned a couple of times with some earnings months. And then we started saying, well, we won't trade those options on those stocks in those earnings months. We'll just stay away from that. Little by little, we said, well, let's go into indexes. Let's look at the index. It takes us out of the earnings season. It takes us out of a lot of the volatility. It smooths it out a little more. And gradually, we just moved into the SPX, NDX, and the Russell.
So now, hey, Linda, let's throw up just some slides just so people can see some of the stuff that we're talking about. First, the SPX. And we just put some slides together so you can see. So the SPX is the S&P 500, and we'll leave that up for a second. Then we'll put up the NDX, and then we'll put up the RUT so you can see. Now, would you say today that most of your trading today is in the SPX?
Yes.
And the reason that you use the SPX is because you've actually got a little too big to trade the spiders. If you had a smaller account, you'd probably trade the spiders?
Probably if I was trading my personal account, I'd probably be in SPY, IWM, QQQQ.
I mean, if you're just a normal person with like 600 grand to throw around, that kind of thing, right? A smaller account.
I've been there. Yes, but with the SPX, you get it's very liquid. We can trade the way we want to trade. We get the premium we want to. We get a good premium, and there's a tax advantage to the SPX. 1256 contract, so 60%. For right now, 60% is taxed as long-term capital gain.
Right, 60-40, 28% max.
Right.
Yeah. So there is. So now we're focused on kind of one product, but let's take it a couple steps further.
Okay.
We believe that there is a lot of logic in the number of occurrences. When you started to ramp up your trading, were you also able to ramp up, as we call it, the number of occurrences? Meaning, do you, even to this day, do you remain relatively active?
We're very active.
Okay, explain what that means.
Active. As far as our trading goes, we are putting contracts on mainly in the next month, and we're closing them down for profit and putting those back on. We're theta traders. Theta means everything to us. Using that time decay in options, and when that time, when our positions get into the current month, we pretty much leave them alone and let them expire, and we're already out in the next month working. So depending on volatility, if the volatility is higher, we flip these. We call them just churning, just selling and buying back, selling and buying back, as long as we can pull as much time value out of it as possible. And then when that dries up, we usually just let them expire worthless.
There is a term, it's called laddering, which means that you would do, like, for example, right now, November is 30 days, December is, 55 or 60 days, that kind of thing. And then January is whatever, 90 days. That we would call that laddering out positions. Do you have a certain time frame that you look for when you're making trades? Like if you were to look at a blank screen and you can choose the perfect number of days to expiration for your methodology, how many days would that be?
It's 56. It's just a number we use because it's 8 weeks. We look at getting the maximum time value, but we want that to start decaying and I think theta starts decaying around 45 days. So we're trying to get as much time value, but we don't like to get way out in the future. December is getting close, and we'll be trading December first of next week probably.
That's
but I don't want to get
days.
in. I don't want to get in. Really?
Yeah, it's 65
Amazing.
right now.
But I don't want to get in January. I just not knowing what the market's going to do. I don't want to be stretched out
Do
that
you
far.
find yourself with the volatility, low volatility environment that we have now, that you're going out a little bit further than you're comfortable with, or
Not really. We're
sticking to
pretty
the
much
basics?
sticking to it. It's brought our returns lower. We're still having a decent year, but it is lower because
As long
of
as
the
we're above
volatility.
ground, we're doing good, right?
Hey, we haven't had a losing month yet, so I'm okay with it. But it is lower.
56 days is actually a little bit longer than our wheelhouse, but it's at the outside end of our wheelhouse. But what's fascinating about that is that the longer you go out, actually, the more you kind of define your risk. So I assume that's one of the reasons it's a little less risky when you go out a little bit further, because you can get a little wider.
We get wider.
Right.
We love that.
So when you look at positions, because I think what everybody wants to hear are the specifics.
Okay.
So the first specific that popped out was that 55, 56 days, because the industry has a tendency now to go towards a shorter time frame. Like, do you use weekly options?
We have. We've been kind of testing the waters this year. I can't say I'm a big fan of the weeklies.
Sure.
Probably will trim that down. But with the low volatility, we've been able to make some profit in the weeklies. Still, our bread and butter is going out the 56 days.
Now, we've had, I think most people it would be fair to say that if you were managing $100,000 and I said you were up 30% this year and we're just heading into the fourth quarter right now, you would say, okay, Tony, that's an amazing return. You did a great job.
No doubt.
But just to put Karen in perspective here, she's managing right now about 95 million total. And this year she's up 30% net going into the fourth quarter. So, and that's after fees and everything else, 30%. I just want to put this. I want to put this discussion into perspective, because the numbers are. This is a tough year. Volatility is. We're hovering around.
14, 15%.
So let's take the next. So we've got to 55 days. Now let's talk a little bit about some of the strategies. Like if you were to employ, as you said, early next week, maybe a December position. Let's talk about some of the things that you may do.
Well, we trick ourselves. We pretend like the market has fallen. So under the old saying that the market only crashes down, the market doesn't crash up. So we feel like we have to protect ourselves the most on the downside. We've had some difficult times this year with the move up on the upside. But we say the market is lower than what it really is, and then we go 12% below that. We use the Analyze tab on ThinkOrSwim, and where the current number is, we pretend like that number's already dropped. Right now we're looking at around 1370. We're saying the market's at 1370.
So you're at 1450, the real market, and you kind of make up this fictional 1370.
We pretend.
Okay.
It's really at 1370, and then we drop it down 12% below that.
And then you take it down 12% below the
that.
1370, which generally takes you to a probability of being in the money of about what?
Probability of being in the money of about 5%.
Okay. So, Tony, we've been doing a lot of experiments with that probability of being in the money. Karen, you'd have loved the stuff we've been pumping out research-wise. But the probability of being in the money of around 5%. Tony, can you show what that means?
Got it here.
Okay.
So you're looking basically at the 1220 puts in December is where I am right now.
Okay, and that would be, and Tony, just hold your cursor to the probability of being in the money at 5%. And Karen, I hate to keep going back to this, but I wanted everybody to understand that's all you have. I mean, that's all you look at.
Yes, but
Okay.
with the amount of money that we're talking about, we will trade very actively around 1220, maybe 1225, 1215, and we'll turn that 2 or 3 times.
And will you also now? When you say you'll trade that means your opening trade is to sell those.
Let's sell. Yes.
Right. Now, what about the upside? When you sell those puts, will you also sell a corresponding call because it requires no additional capital?
No, we leg into each side. We will sell calls, but we sell them. Today would be a terrific day to be selling calls.
Okay.
Why?
The market was up. Not having everything in front of me today, I haven't seen the market today.
I just want to get it. I just want to get across that you sell on an upswing as opposed to sell on a downswing.
and
You're
then
contrarian.
sell puts on a downswing because again we can get further out. We're trying to widen that as much as we can. We watch. We have Bollinger Bands on our SPX chart at 2 standard deviations. We want to be out from that. The upside is a much greater challenge than the downside. If I'm trading down at that level, I'm not worried about it. I'm really not worried about it. If the market falls that hard, we're in trouble for a lot more reasons than just this.
Than your upside protection.
Mm-hmm.
So
the upside, it's tough. We're probably a little closer in and looking more around the 10% on the upside.
So let's take a look at what that means on the upside, Tony. And then Linda, after Tony's done with this, if you could throw up what a strangle is on the board, that'd be great.
So you look at approximately the 1540s or the 1545s.
We would look at that, and then we'd look at our charts. We'd see where we thought a strong resistance level was. We would make sure we'd get above that resistance level. So all that comes into play when we're looking at the upside.
And would you sell an equal number of upside and downside, or is it
Not
some
necessarily.
kind of ratio?
Not we're a little softer on the upside. We'll sell more on the put side. We can make more money.
Okay.
And be safer. Be out further.
So let's talk a little bit about what you just talked about there. Is your target, and I think this is the most interesting thing about what you do as compared to what a lot of how we trade. Number one, you're a little uneven when it comes to the amount of sells that you have on both sides of the market, and your focus seems to be more on premium collected rather than on the mechanics of being equal on both sides of the market.
It is driven by the Analyze tab, and where we are 10% up from the current position and where we are 12% down. We watch that. That is compared to our net lick, and we just don't want to be pushing up close to that net lick. So that drives us much more than number of contracts or whether our positions are even or not.
So it's more of a buy. We've said this for many years. It's much more of you're managing your buying power reduction as it relates to your net lick.
Yes.
More than you're managing some kind of mechanics around a specific standard deviation move.
Yes, I would say that. Uh-huh.
Okay.
Yes.
I'm getting the emails because you've said it a few times. Now, our conspiracy theorists that are in the audience are thinking that maybe you're that Kaiser Sosa type of person where, you're that the they that we've been looking for, the we, the they. Please tell us who we is. Is it a team of 60, 600?
It's a team of six.
6.
5 traders and 1 number cruncher.
Gotcha.
So,
and that number cruncher goes over all of the volatility in all of the market?
The traders do that. The number cruncher tells me how much money I made every day.
I just want to make it clear.
So let's get back to this. Let's get back to this discussion because I'm trying to get lots of different takeaways for our members. And the next takeaway is so people have a big issue. So here's the amazing thing about what you've done is you did the what everybody thought was the impossible, which is scaling a logic that everybody gets the logic here, but scaling it. So you're, and again, I want to go back to this. You're in your mid 50s and you're basically rolling the dice big time. Because at some point, okay, you're not holding back. How much capital are you committing at this point in your life? Like we're talking 2009, 2010, 2011. How much capital are you committing of the total capital when you trade? Like I might commit 20% or 15%, or Tony maybe 20 or 25%. I don't know what it is, but you're up there.
We've got a suggestive target of 50% capital committed.
Okay.
And that'll range. We'll commit up to 70%. It depends on the situation, 70 to 80%, and then we'll try to pull it back at any given time. We may be stretched a little further out than we want to be. I love 50%. I love having a bank sitting there that if the market moves on me and I need to move some positions, I've got the capital to do it. So I don't have to sit there and I don't put stop losses on. I
never use a stop loss?
Never use a stop. I hate stop losses.
Okay.
I want to manage my account. I don't want anything automatically happening to my account. We've got 5 people sitting there watching this all day. We don't need to put stop losses on.
I love the fact that you just said that. But continuing to move in the same direction. So you commit a significant amount of capital. And obviously, if everything's going good, all right, no harm, no foul. But let's talk about all of a sudden now something happens. It could be an event. It could be a one-time binary event. It could be something. Who cares what it is? It could be the flash crash of 2010. It doesn't make any difference. But you have these very large positions on. Although they're liquid products, there are they don't always make people comfortable. We like to define risk through size. Meaning keep our size small, define your risk. You are much more of an all-in trader. You're not all in, but you're more in than most people. Otherwise, you couldn't get to these numbers. What do you do what's the mental stop point? First, what's the mental stop point? And then what do you do when the trades go against you?
I'm more all in, but at a much further out range. And that's how I justify that in my mind. Our first goal is to not lose anybody's money, and that's very important to me. So staying out 5%, sometimes we're at 1% of probability of being in the money. What do I do? How's the best way to just?
Well, let's put it this way. Let me ask
this?
the first question. First question is where is that mental stop? Is it if you're 5% out of the money? Is the first spot that you get concerned about at 10%, or is it at 30%?
From that,
yes.
If a position moves up to 30%, then we're just keying in on it, saying, what are we looking at? What's the problem here? What's happening to the market? Could this position get into trouble quickly? If we're not comfortable leaving it where it is, we start what we call tweaking it. We will move pieces of it. We'll roll a part of it up. Let's say it's a call.
Sure.
We'll roll a part of it up.
And you're being tested to the upside.
We're being tested to the upside. We'll move a part of it up. We'll put on some more puts in a position where we feel safe.
So let's give an example here.
Let's
give an example here.
The difference.
Tony, let's go to a 10% out of the money call. Okay, I'm sorry, where it's 10% chance of getting in the money. We had it up there before in the SPX.
1540.
So the 1540 line there, you can see the market is 350 at 430. This is December. Now, assuming you sold this, let's just say, for example, the market started to rally up. Now, are we looking at the December? Are we looking at the 1490 in December as that being kind of that 30% chance of being in the money, as you can see at the top of the page?
Yes,
or are we going to kind of a November option?
So what Tom's saying is,
no.
Oh, go ahead.
We're looking at the December.
So it's December versus
December.
Getting into
that position getting into.
So if your new probability of being in the money on the 1540 call was actually 30%, that's a trigger to you.
That's a trigger.
That I got to start looking at something, see what the market's doing, what's my assumption on the overall market, and then either do something by rolling up the calls or selling more puts.
If it's gone from 15 to 30, it needs my attention. I need to be watching it, and we're watching it as it moves up. But at 30, we're saying it's time to do something.
And time left in the expiration
Yes.
would also come into play, right?
So I made the comment last May that since we're selling premium, once we get the money, we're not giving it back. And what I mean by that...
Yeah, you said that in the first interview. We got a lot of emails about it. So
if that position gets into trouble, and let's say, for simplicity's sake, it brought in $1,000.
Sure.
And I may have to spend... if I have to spend $2,000 to roll it up and get it out of trouble, I'm going to get some money from some premium by rolling it up. I'm going to make up the difference on the put side, or I'm going to put a few more contracts on the call side. But
okay, so let's
save
understand
further out, and also maybe sell some puts.
This is a fundamental difference between the way almost everybody trades, including myself. This is not kind of a traditional methodology for rolling up a tested side. The traditional methodology would be to roll up something else or to make an adjustment, whatever. What you're saying is, and I just correct me if I'm wrong, but what you're saying is you get to that point where the mental number kicks in, where you go from a 10% to a 30% chance, and the next adjustment that you're making is you're either rolling out in time to reduce your delta risk.
Yes.
You're either covering some of that position and which costs you money, and then to make up for that, you're selling more of the other side, in this case, a put side, to make up that same money so you don't so that theoretically when everything expires, you're back at the same spot.
Back at the same spot. I don't care where it comes from. I don't get emotional about any position. Let it go. Fix it. Do whatever you have to do to just make yourself whole at expiration date. So we don't care what it takes as long as it makes sense in what we're doing. We try to make these decisions where we're not putting ourselves in greater risk. But if the market's been moving up like that, and say we've got puts on that we put on at 5%. Probability of in the money, they're probably now down to less than 1%.
Sure.
We can put more puts on higher. We can maybe go 10% if we need to, but with the knowledge that what the market is showing us, that's a pretty safe bet at that point. So whatever it costs us to get the call out of trouble, we make that difference up somewhere.
Have you and please show the 5% number up there too, Linda. 5% of the money. Have you effectively gamified trading to just a numbers game? Like did you, like, in your mind before we thought of this, because I like to take credit for everything, before we thought of this, did you effectively somehow gamify this so that, not that you knew that 5% equals 1.64 standard, but did you try to make it into a numbers game? You don't have a market opinion, do you?
I don't, and I love that word. It is a big board game to me. I mean, I just love it, and that's why I enjoy playing it. It's a challenge. But I see it as a big game. It's numbers to me. So when you can put that objective viewpoint into it, and you don't have feelings wrapped up in it, and it's just, I look at the numbers, and I know what it means to take a loss, and we have taken losses, but overall, percentage-wise, we have a heavy percent that are winners because we just look at the numbers. It's just an unemotional process that we go through.
Has your biggest loss been larger than your biggest gain in a month time period? Pretty close?
No. I'd have to think about that. I mean, we've had no losses in a month this year. Last year, we had 1 month that we had a loss, and that month was
November.
August. Then slam dance. In August, the margin requirements changed on us, and we had to close down positions to get our analyze tab back into sync. It happened instantaneously. So without any warning, we had to just go in and start closing positions down. And that created a loss.
Is there
for the month.
I get a lot of questions regarding some of the ways you trade with respect to, we love the simplistic nature of it. Simplistic strategic approach, simplistic underlying, meaning very few underlyings, very, very, very low key on the analytical stuff, and a very low key approach to the markets in general, not trying to overanalyze, and no noise from the outside, no news, very little technicals, everything. So is there a delta number? Like, is there amount of directional risk where you start to get uncomfortable, or is it all tied into that 30% number?
Honestly, it's tied into the 30% number.
Wow.
You may be able to teach me some things that I can do better, but what we've worked worked through for the last few years, we just tied into that 30% number.
30 years of trading says that I can't. 30 years, and God knows I've tried.
I can second that.
It works for us. It works for us. So if it ain't broke, don't fix it. Sort of philosophy.
I completely understand that. Do you get into a situation where you will use multiple products? So, for example, you said that your primary product is the SPX, which is the S&P 500. But will you get into a situation? I'm not talking about pairs trading. I'm talking about like where you have a position on it in the SPX. Will you potentially, because there's a higher volatility in the RUT or a higher volatility in the NASDAQ and the NDX, would you consider trading different products, and do you look at those positions having some relationship to each other, or are you pretty independent in the positions?
It's independent. We had one year, I don't remember off the top of my head, that we made more money in Russell than we did in the SPX, and that's very unusual for us. It was just a good year for Russell. I think maybe it was 2009. With our analytical work, honestly, the SPX just comes out on top over and over and over. So we sit there and think, well, why would we want to put a trade on the NDX when we can get a greater rate of return at the same risk level on the SPX?
Now,
why do that?
The normal retail trader is trading 10 contracts at a time. I know you're trading significantly higher. Do you have any problem finding liquidity in the SPX or anything like that?
No, we have not. None at all. And we're trading high numbers of contracts.
Sure.
So
the reason we don't trade SPY is cost.
Sure.
When you're trading that volume, if I was doing it for myself,
commission-wise, it's 10 to 1.
I'd be back.
Sure.
I'd be back in the SPY.
There is there's a lot of discussion that goes on all the time about the need to use, and we do it on the show a lot. We feel it's important to mix up different strategies. I mean, maybe you've gotten to the point where that's more of a nuisance than it is, but do you still find yourself kind of going back to the well sometimes, especially when volatility is in that 13-14% range like it is now? Do you find yourself going back to kind of some old school choices, like, and say, you know what, we should do a big wide iron condor here. We should do, I mean, do you ever do credit spreads or iron condors anymore?
No, we don't, because we found are you ready for this, Tony?
Go ahead.
The naked place.
I love it when a Southern girl says naked. There's nothing better in the whole world.
No, I'm not from upstate New York. We can just get so much further out. We just stay with the low volatility is it's given us a real challenge this year. So we just told our clients we would have lower rates of return this year because of the low volatility.
You made 30% through 3 quarters. They better not be complaining.
My expectations are always higher. I like to dream bigger, and then it just comes in the way it comes in. After a year like last year, our investors have a lot of fun seeing the bigger returns, but I just said this year with the low volatility, it's just too difficult, and we still want to stay in trading in those safe ranges. There's
just based on normal marketplace cyclicality and based on trends that we've seen over the years, volatility on volatility is, just under 100%. So the expectations for the VIX, for example, to trade next year close to 30, as much as it's going to trade 15, those chances are highly likely. So
can't wait.
So is it a can't wait, or is it like, are you going to get hurt in that process of going from 15 to 30? Or how do you defend that, I guess, is the best way? That's
where the dancing becomes really tricky. The going from a high volatility environment to a low volatility, or vice versa, low volatility to high volatility. Those are some dangerous grounds. I did the analogy, it's like trying to turn a battleship around in a river. It's just so difficult, and it's time consuming. We watch that. We talk about it as a group. That probably makes me as nervous as anything. It's when that switch takes place. If you're loaded up on the downside and you have one of those days, it can make life very difficult.
Is it a group decision, as a dictatorship is a group decision, or is it really a group decision? I mean, there's 6 of you. You could be 3-3 and split.
It's usually, we talk about all the different choices. And we agree as a group. We've got a tremendous trading group in that small room. We have CPAs and lawyers and people who have traded for a long time. And we all think very similarly, but I love it when people come in with different ideas and we discuss it.
Let's talk about that group for a second.
Vital listening to those discussions.
Those are your friends.
Yes.
Those are retail customers too.
They are all retail customers.
Okay, I just want to be clear that this is not, you didn't come to Chicago, walk on the floor and say, hey, you and you in the blue coat, the red coat, and the green coat, come with me to wherever home is, okay? You basically, you're talking about your friends that went to the same Investools class
Met
that you
one
did.
of the lawyer met him in an Investools class.
Okay.
It's an incredible story.
Yeah,
really.
it's freaking people out right now because so many people have similar they're all thinking, how come she didn't meet me?
Jill and I kept talking about that bagel shop we wanted to open, and we just started trading instead and found out that we probably made more money trading than cooking bagels.
Probably. It's just a guess. Yeah.
They're all people that have
so
been friends
let's
over
talk
years.
about. I have a couple more questions that I really want to get in there. I hope you don't mind. Can you go a few minutes over?
Sure.
Okay. So there's so all of a sudden volatility goes from 15 to 25%. Now the question that everybody asks is, okay, well in hindsight, if it stops at 25 and goes back to 15, you're a genius. But what if it goes from 25 to 40? Like at what point, Karen, do you say, because you're laddering out your positions 55 days.
Right.
At what point are you saying we should be all in at 28% or we should be what, 20% in? Like the hardest thing for people that are listening is they're all thinking scale. Okay, this woman scaled up somehow, but I can't scale up. And I got to tell you, it's not easy. I get it. So how does that work?
Oh, gee. See, I don't think about it that way. We
Okay.
just do what we do every day. And as more money comes in, we just look at our Analyze tab and we increase the number of contracts. We're still playing the same game. We're still in the same position. We just increase the number of contracts.
So when the money rolls over, you just keep doing it.
But keep in mind, we pretend as if the market's already dropped. So we start at a minimum of 100 points down. So if the market starts falling, the idea is we've got time to start adjusting our positions, reducing our positions. We've got time in one of those strong downfalls to react to it and manage it and
But you basically go 10% probability of success to the upside and 5% to the downside, correct?
yes.
But okay, so when you do that, because this is important takeaway,
Okay.
when we were traders and trading index products the same way, we would always maintain short premium and short delta, which means we had some short directional protection on. You essentially, through however you got there, you got to the same spot. So your primary position is you're always, based on what you just said, you're always kind of short a little delta and you're short premium.
Yes.
And the assumption is that volatility expands, the velocity of the down move that's going to protect you in the velocity of a down move. Flash crash 2010, May 6th, 2010.
Great day in the market.
Yeah, dark day. Everything
Dark
shut
day.
down.
Yes, Jill and I were sitting there by ourselves. We hadn't expanded to this level back then, watching
Do
the
you
market
turn
do
over
that.
your screens the way we do sometimes if the market's not going the right direction
That's
and just
a
to
good
make
idea.
the chart
We
look
didn't
the
try
right
that
way?
that day.
Try it. It works very well. I've been doing it for 30 years.
Black tape works too, but what'd you do?
We talked with ThinkOrSwim on the phone several times, and we pushed positions out. So you're sitting there, the Dow's falling 1,000 points in 10 minutes. You don't know if Armageddon is hitting. You don't know what's happening. And we just moved positions out. We increased positions where we had to, but we went out into October, November. We're sitting there in April. We essentially gave up our profits for a few months to get into some kind of safe territory. We went into the bomb shelter is what we were trying to do.
Okay.
Was just push everything forward, give us time so we can see what in the world is going on here. So we did. We protected principal, we'd push those positions out, and we sat there for a few months and waited until the market settled down. And from about October through December, we finished our trading out for the year.
Yeah,
And we had a profitable year.
Yeah, you did in 2010, and then you killed them in 2011. You did great. Is that the worst moment in the last 5 years?
That was the worst moment. Last August was not fun when we had there's no reason why we should have had a losing month last year. And those things are real hard on me. I take them
How much
very
money
personally.
did you lose last August?
We lost a 4.5% in the month of August for the month, but we still ended up the year at 53%.
So you lost 4.5% of the month in the month of August, which was your worst month.
Worst month.
So that must have been about $5 million, something like that, $4 or $5 million. And then you ended up the year up 53%.
We'd had some really good months up to that. We'd had some really good months up
You
to that.
call yourself a trader? Look at you over there. Seriously.
Seriously, this is not.
Listen, Karen,
I used to-
we usually start at 7 a.m., but obviously you can do things that he can't do. Let's just start at 8:30 Central when the bell rings, and we'll go to
Sure.
about 9 o'clock. We'll get all this taken care of. We'll go to
Okay.
breakfast. We'll come back at 2:30, wrap it all up. Right, dear?
Sure, that'll be fine.
You don't need me.
No.
Okay, seriously, you don't need me. Again, I can't, only because I've been there. Again, I've seen every tick for the last, something like 30 years trying to figure out, and I've watched people constantly adjust and tweak and overmanage and things like that. You don't focus on daily. You look at your P&L, but your focus isn't on your P&L. Your focus is on your numbers.
Yes.
Your problem,
absolutely.
your standard deviations, whatever you want to call the numbers.
They are numbers to me. They are literally numbers to me. So it's that again. It's a big game board, and I don't mean to belittle it, but it's a process. So we are all managing that process, so that we don't get involved with, oh my gosh, we're losing here, or we're making this much money, or it becomes money when the paychecks are written at the end of the month.
But you really concentrate on your net lick at the end of the month more than your net risk.
Yes, we do.
I mean, you're always
Yes, we
conscious
do.
of your
Yes,
risk,
sir.
but a lot of retail traders will always say, oh, I'm risking $1,800 here, and that's too much risk for me, even though I want to make $400 on that $1,800. It's just too much for me. But you really concentrate on how much you can make.
Yes.
Inside
yes.
your comfort zone.
Yes. Yes. I know I have some friends that say, well, I can only make 2% on that play for this month, so that's not enough. And to me, 2% is better than zero. So if that's all I can do for the month, I'm perfectly satisfied with that.
Based on the numbers that you've thrown out here today, and you and I talked about this earlier today, you set a target for your positions of what you suggested is around 15% for that 55-day period. And that's another thing that goes through your mind. And I'm just curious, when as you said, when the light bulb went off in 2009, 2010, and you migrated from risk-defined spreads to undefined risk. Okay, how hard was that transition, or was it just like all of a sudden you recognize, hey, I got to do this?
It was just as natural as it could be. It's just looking at the numbers, and this makes more sense to move. We can get further out and still make the same premium that we were making in the iron condors. We can get much safer, still make the same premium. Why wouldn't we do that?
We use the argument, Tony and I do all the time, to individual investors that if you define your risk, you increase your probability of success.
Okay.
I'm sorry. If you define your profitability, you increase your probability of success. You did that on your own, because that's not something that is generally taught in any kind of investor education. You had to come full circle. How'd you do that?
I really didn't know that I had done that until I met you. So it just made
please,
sense.
I'm going to have to get his head through the door sometime tomorrow.
Oh, I'm hoping to get a beret.
Oh, you play cards right, I'll get you one.
It just made mathematical sense to me to move in the direction that we moved. I did not do any great analysis. I just looked at the numbers and we just migrated toward.
Is your math background? Do you feel like, listen, you can downplay your success as much as you want to, but there's something in there, there's something that clicked somewhere along because it's not normal what's happening here. So something clicked. Do you think when you look back
some people would say instead of that, like not normal,
not normal.
like if they were conducting an interview, they might say something, it's extraordinary, or it's you've learned to do something that, even I, being, the great one, Tom Sosnof, has not been able to do, as opposed to not normal. Like, that normal is just not right.
Not normal.
Jill's in the next room. She would agree that I'm not normal. My math background and my accounting background, I've dealt with numbers my entire professional career. It just makes sense.
So were you able to take the stock market emotion, which is what takes down most people, is the ripping at your insides, the stock market emotion, the perceived risk. You were able to turn that into some kind of a numbers event and just focus on the numbers.
I got tired of that ripping the heart out. I don't want to go to bed at night feeling that way. I don't want to be scared of what's going to happen in the market. So we just kept working. How can we make this safer? How can we make in my mind, it's safer by going that far out of the money.
Karen, you mentioned 56 days. So are you all in at 56 days?
50%, she said.
50%?
Yeah, 50 to 70%, depending on what's going on in the market.
And will you have multiple months on? If you're at a comfort level, will you have multiple months on? Like, will you have October and December now? Or November and December?
Yeah, we'll have a current and out month.
Okay.
October is
30 days or so to go.
See, in November,
Yeah.
by the time we get to October 30th, we will have closed most of our November positions down and brought the realized income back into October. So by the time we get into November, there's very little exposure there. And what's left is usually just so worthless, we just ignore it. It also takes up our buying power on our analyze tab, so we like cleaning that current month out, and then we'll
freeing
be
up the capital like any other
freeing up
retail
and
investor.
getting back into, and then we'll get into December and hit December hard.
Karen, there's some people, I know you use futures and futures options, and not as much anymore, but do you ever use products to control your volatility risk like the VIX? Would you ever consider like a complementary or hedge position if you're short? I mean, you're short professional levels, hedge fund levels of premium. Do you consider like call spreads in the VIX, that kind of stuff, or you just totally avoid it?
We have done that in the past.
Yes.
I haven't done it recently.
Okay.
I may go back and look at it now.
I'm only saying because we're at the low end of sometimes
Yes.
commodities get to the low end of a range. So what's next? How linear is this, meaning that can you actually scale bigger than you currently are, or are you at a good, comfortable number?
I am at a good, comfortable number. The fact that one of the funds, the money, the profit goes into, the net profit goes into the charity, I'm always interested. There's a potential that we'll start one more fund set up that way. And in my mind, that's it. I don't want to manage any more than that. But we still have room to grow. How
much of your life do you spend on the road working these charities? I'm just curious. Like, it's one thing to say, okay, I'm going to manage, gazillion short positions and all this kind of stuff. How often are you actually just
having the team we have gives me the flexibility. I'm in Africa about once a quarter, and I'm over there for 10 days, 2 weeks.
I think I'm in hell once a quarter sometimes. I don't even leave this room. There are so many incredible little tidbits in here that I think people are going to grab for quite some time. Again, I'll go back to the simplicity of it all. There's this Karen, there's this popular idea that you need, in order to be successful, you have to outsmart or the game is rigged. Is the game rigged?
No, not at all.
Right.
I mean, and all the tools are there.
For free.
For free. That's
who could build 100
commissions.
Well, okay, but still,
still,
you're talking about hundreds of millions of dollars of business with.
I could not have done this in any other way. I could have tried to build a business. I couldn't sell enough bagels to do this, and this
That's
is
for
just
damn sure.
And it's
Either
just
that or it's
opened
a
up.
lot of bagels.
It's opened up a world for me that is just amazing. It's just amazing that what this affords me to do, and that's the work in Africa.
Do you still love coming into work every day and just?
I love it. I love it. I love it. The first thing that hits my mind when I wake up in the morning, what are the futures doing? I just,
Don't worry. First thing,
every trader.
every single trader. So you've crossed over into the dark side.
I am happily in the dark side. I love it.
I'm Tom Sosnof. He's Tony Batista. She is Karen, the SuperTrader.
She is Thomas. I got to clarify one thing, just because our president downstairs is going a little nutty on me. The UGMA accounts into perpetuity is really till about 18 or 21, depending on your.
Thank you for ruining a beautiful close.
It was a beautiful close.
Thank you.
Depending on your state, TDA is only waiving those till the age of majority.
Okay, whatever. Fine. Thank you.
Yes.
Thank you, sir.
You're welcome.
I'm Tom Sosnof again. He's Tony Batista. She's Karen, the SuperTrader. This segment will be archived, and I hope, Karen, that you can come back for years and years and years to TastyTrade, and we can have this this discussion. I could do this discussion. We've already sat down for a couple hours today. We could have this discussion once a week for the rest of my life, as far as I'm concerned, because you have no idea, to experienced traders, what this means to us.
That's what's so fun to me. I have no idea.
Right.
I'm amazed that
you asked
me to come back.
You're too damn innocent. You're too normal. Something's wrong, Tony. Tony, something's wrong.
Yeah, I think
You're supposed to be like in a mink coat.
You already told her she's not normal. It's okay, Tom. Enough said. You see what I have to
Something's
deal with every day.
I'll leave with that.
Thank you so much for coming
Thank
to
you.
TastyTrades Studios, and thanks everybody for watching and for enjoying both of our shows tonight. And we will see you back tomorrow morning at 7 a.m. Peace.
Peace. Good evening, my friends. Tonight we have a special treat for you. I'm Tony Batista. He's Tom Sosnof, and our special guest, Karen the SuperTrader. Welcome.
Thank you. It's great to be here again for the third time.
Hello, Bat. Hi, Karen. How are you?
I'm great.
How do you like the fact that your official name has been changed to Karen the SuperTrader?
There's another person out there that's not me. I mean,
Really?
I just oh no, I can't get my arms around that.
Tony and I were talking before the show started tonight, and we tried to figure out who named you Karen the SuperTrader, and I think it was Tony V, our producer. But I'm like, that was the greatest name choice.
You never would have picked it.
Thank you so much.
Nor would I.
Thank you so much for coming back.
Pleasure. Thank you for
And it's
asking
been a
me.
year and 3 months since our last talk. I think it was like at the end of 2012 or something.
And what a year it's been.
And it was a challenging year. How was 2013? Not results wise yet, but just like, were you challenged by the fact that volatility was so cheap all year?
It was murder. It was very challenging. It challenged us from all perspectives of how we traded in 2011, how we traded in 2012, and then 2013 was just a curveball.
Were you challenged in 2013 because the market went up pretty much the whole year?
And the VIX stayed down.
And the VIX stayed down.
We want volatility, and we didn't get any in 2013. So it was a real challenge.
What's your volatility wheelhouse? Like when you look at the VIX and you say, if I could set this thing at a certain number, like my perfect number would be?
Perfect number, I would pick 20.
20. 18
to 20. When it popped to 19, I was in heaven. I love it.
Last year, Tony and I, we traded every day, just like you traded every single day last year. So I think I think we feel pretty good, Bat, about having this conversation.
Absolutely. When you're talking about volatility popping up to 20, you're talking about 4 or 5 days ago, right?
Yeah. And I can't wait till it comes back. If we could have a whole year, 15 to 20, it would be terrific.
So let's talk first before we get started. And I promised everybody listening tonight, thanks to the entire Tasty Nation for coming out tonight. I promised everybody that last 2 interviews we did, they were designed to be really inspirational. Tonight, I wanted to be inspirational, but also get into some specifics, some of the mechanics, some of the processes you use. But I think we first need to at least have a little discussion about 2013 because we haven't talked to you since 2012. Now, I didn't ask you, and you didn't. We didn't really get into specifics until today.
Right.
Let's talk about 2013. Your primary product in 2013 was what?
SPX.
And I would say that you, based on what you said to me, either SPX or the equivalent SPX, futures options, that was almost 100%.
ES is SPX.
Almost 100% of what you traded. Okay, because that's really easy to relate the VIX to what Karen traded.
Sure.
No earnings plays, no special situations.
No.
Just the SPX and the S&P 500. Okay. I looked through very carefully. We discussed your results last year, and you are currently managing about $196 million.
Yes. Yes.
And let's talk a little
Between
bit.
two funds.
Between two funds. But they do basically the same thing. $196 million, and one fund returned net after expenses 27.5%, and the other fund returned net after expenses 24%.
Yes. For 2013.
You should be ashamed of yourself.
Oh.
I'm already ashamed of myself. That's why I'm here tonight, to show pity for myself.
But it was a tough 27.5%. Our benchmark's the S&P, and I so
How do you
wanted
have
to
a
beat
benchmark
the
of the
S&P.
S&P? Like, why is the benchmark your S&P if you're actually trading? You know what I'm saying? I obviously you need a benchmark for discussion purposes. But if the S&P is down 30% 1 year, that
You don't want to be down 25% and do better than the S&P.
No. But just in 2013,
So you're saying if the
got
S&P
so close. I got so close.
So you're saying if the S&P has a positive return, you want to have a positive return that's much better than that?
Yes. What we do, we should at least be able to beat the S&P. That I'm always going to have that attitude, but never lose money. And that's my attitude. Can we lose? Of course we can, but
Index
we
funds,
certainly don't start out.
Index funds, bullish index funds, long stock funds were about the only thing that came close to, matching the S&P, that kind of thing. Most of the stat ARB funds, the long short funds, the index ARB funds, most of anything that had bonds or mixed instruments in it, nothing even came close to those numbers. In fact, most of the hedge funds were less than 5 or 6% that weren't just long funds. How does the world deliver a 5% return on basically an ARB fund, and you can deliver a 27% return? And this is a real number. $200 million is a real number.
It's a real number. It's really true.
Oh, don't worry. We will. And the crazy part about it too was you didn't have a losing month in 2013.
No, and we were talking earlier. I said we close out every month with a real hard close. We don't take the luxury of rolling out to next month. So when we have a return like we had each month in 2013, those are real closed positions, no rolling out to the next month.
Just to put some of these numbers in perspective, okay, at 24, the average return between the two funds, one was 27.5% and one was 24%. This is after all fees, okay, after all fees. How'd you do in January this year?
We were up 2.2% for the month, and the S&P was down 3.6%.
There you go.
We had a good January, yes.
So you have a streak going from the beginning of last year, 13 straight months. You're definitely buying dinner tonight because this is ridiculously incredible.
I should be ashamed of myself. You got a new nickname coming for you.
Let's just say
Maybe
average,
after this you should be saying that I should be buying dinner.
the total return after all expenses and everything was paid, and I don't want to get into a lot of your specifics about expenses, things like that, but let's just say it's incredibly fair fund. You still netted out over $50 million.
Yes.
Yeah, that's coming from a professional background because you trade products that we traded. It blows my mind.
And you know my
consistency.
background. I mean, I just started by going to a class and thinking, that sounds really interesting. Maybe I can do that.
No, I'm looking at you over there, Sosnof. You're never too old for some school.
Karen, what about how many people work for you?
We have 7 in total, and that includes me.
7 in total, and 6 of those 7 are traders?
One is a controller.
Okay. But the rest are traders.
Yes, the rest are
And
traders.
how obviously, you've got a lot of stuff going on. So there's a lot of other people participate in the process of executing trades. How do you ramp those other traders up? How do you get them up to speed?
It's the power of being in that room. We've got great people in that room, and the success goes to all of them. We are in a big, not quite a circle, but we turn our chairs around and we all talk as a group, and we plan and strategize as a group, and there's a lot of power in that. And if anyone that's out there trading by themselves, outside of watching you guys every day, find a partner, find somebody you can trade with. There's a lot of power in that. So we get a lot of ideas going back and forth all day. It's very energizing. I love it.
You told me earlier you made almost 50, as a group, all the funds, almost 50,000 trades last year. I'm not even going to get into how much that was in fees. But your average size trade is 500 contracts.
About 500 contracts would
About
be
500
the
contracts
average size
in the
trade.
SPX. And we know, Tony, that's the equivalent of a 5,000 lot in the spiders.
That's correct.
Yes.
Just
In SPY.
That's the main reason I don't trade spiders, is because of the cost of trading that many, putting on that many contracts in the spiders. SPX.
Have you looked at liquidity anywhere else outside of the SPX?
No, we have never had a problem with liquidity in SPX, and we also trade the options on the futures, the ES minis. We look at the Russell, the RUT, and the NDX, and we can always go to that if we're looking for some other position to put on. But our basic index is the SPX. There's also a tax advantage to that too. We get a 1256 contract tax advantage, so our investors get a tax advantage on top of all that.
There's I mentioned this to Tony earlier.
With Tom's performance this year, he doesn't have to worry about taxes so far. No, it's not going to be an issue.
Those loss carry forwards, man. I got enough of those.
He's got those buttoned up. We're fine.
Well, that's good. That's good tax planning.
No, it's not.
No, it's not.
There is in the retail side of the business. I just want to be very clear, because people get all, they think, oh, you bring in a pro, and you are a total pro, but you use the same technology that everybody else, not everybody else, but that any other do-it-yourself investor can use.
I started with covered calls. That's what I was taught. My background is in accounting. I'm a CPA. I've been in management and corporations. Fundamental analysis was my bread and butter, and I learned how to do covered calls, and I do the fundamental analysis, pick stocks, and sell covered calls on them. That was how I started.
But the technology you use today is the same technology that Tony and I use.
Yes. Yeah.
Does it feel strange? I mentioned this to, I think, earlier. I think you're probably the largest do-it-yourself investor in the world. It's hard to fathom, doesn't it? I mean, as far as activity goes, which is really interesting to a lot of professionals and stuff that are listening to the show, because to maintain, we all know how hard. I don't care how good. I've been doing this for 33 years, Tony, almost 30 years. We've never had a 12-month
run. No. Not like that. And not those kind of numbers if it did.
It's crazy. I want to get into a lot of kind of specifics with you. But first, before we start, so many people have emailed me over the course of the last year, and they constantly ask me one question. How do you deal with, how do you personally just deal with in your brain, how do you deal with the risk that you take? How do you, best put, how do you sleep at night?
When I got involved in this, it's partly because of my background as an accountant, and I referenced, I think, on one of the shows.
Those accountants, total risk takers.
That's, yeah.
Absolutely.
We're on the edge.
Calculated
We're
risk
on the
takers.
edge. I can control the emotion of fear and greed. You take the fear out of it, you can take the greed out of it is important too. And it's just statistics. My brain goes toward the statistics, goes toward the math. So I referenced that it was like playing a big game. And it is to me, but it's very structured. It's not, I'm not rolling the dice. I'm playing in positions where I've said many times if I could walk up to a blackjack table and know I was going to win 95% of the time, I'd be sitting at that table all night long. And what we do is very similar to that. If we're in a 2 standard deviation, we're at a 5% probability of in the money. 95% odds that our play is going to be successful. Those are great odds. So I have no problem sleeping at night. We're making intelligent decisions and managing those decisions very well.
Did you introduce into your one of the cool things about options is that they're like a gray area, strategic instrument. Did you introduce new products into your strategic mix this year, or did you introduce new strategies that you hadn't done before?
We probably migrated over to the SPX and the ESs and just stayed in those so we could focus. 2013 again was a great challenge. We had a super year. It still was a challenge. 2011 with a high VIX, it was very easy to trade in 2011. So we concentrated in the SPX and the ESs. We focused on that, and we had to pull the edges in a little stronger. In 2011 and 2012, we were more out at the 2 standard deviations. 2013, it was probably closer to 1.5 standard deviations. It's easier on the put side to stay in that range, and on the call side, we really had to pull it in. We went to a shorter time frame on the call side. We look out about 2 weeks. The puts, we were still looking at monthlies, and we had to get pull those edges in, trade with more closer to the money than I'd like to, but the market demanded it.
Okay, so let's talk about this. Let's get into, let's make this the official start here and get into some real specifics, because people are like, they're fast. Man, I'm telling you, Karen, they're fascinated by you. So
appreciate that.
Let's get into some specifics. You just mentioned things like 1 standard deviation and 2 standard deviation. Let's talk about just kind of a very broad picture. And what we did is we actually are going to look at this on 2 different platforms. So we've kind of set it up so we can see. But first, we'll explain it. Just talk about your most basic strategy, because you just started to talk about a little bit. Just talk about the most basic strategy, kind of your go-to strategy.
I loved your show on theta. We live on theta and the VIX. Under normal circumstances, we would go out we use 56 days, and the reason we use 56 days is when we go out that far, we're putting trades on and letting theta start decaying those trades, and we take them off and pull that profit back into the current month. So we're putting on trades, pulling them off, putting on, pulling them off. When it gets down in the 40-day neighborhood, we'll leave them on in the next month.
Now, first of all, let me stop you for a second. When you say you're putting on trades out 56 days, based on what we know about your trading, you're putting on the put side.
Put side.
Put side only, and you look at both sides independent of each other.
Independent, completely independent. We're never putting on any spreads. Never. They're independent. What do we need to do on the put side? What do we need to do on the call side? And that was very important in 2013. 2013, with this market just roaring up, we had to stay lighter on the call side. Had to, but we were maxing out what we could play on the put side.
Okay, so far my understanding is that you'd go out 56 days on the put side, and you would put on trades that were the equivalent of a 2 standard deviation move.
About 5% on the 5% probability of in the money.
On the put side.
On the put side. And you would have the equivalent 2 puts to 1 call.
That's a good way to look at it.
And how about the call side?
The call side, we would go, we're looking more about a 2-week period out and using 10% probability in the money. Because the call side, is more difficult, and when the volatility is low, it's more difficult. You can't make any money. If you were going out at a 5%, you'd be getting 10 cents for your trades. So we had to pull that back in and play it a little tighter, but shorter time period. So we're at risk for a shorter period of time.
So in 2013, just so everybody gets this, you'd sell 2 puts at 2 standard deviations out of the money and 1 call at 1 standard deviation, approximately 1 standard deviation, maybe a little less, out of the money. And the calls would have 14 days to go to expiration, and the puts would have 56 days to go to expiration.
Now, do we do that 100% of the time? No.
Of course,
We see
of course.
I also look at the trend. Number one thing we learned in trading is the trend is your friend. Look at the trend first. In 2013, we were doing projections on the call side. So if we got some good premium 50 days out and we could project a trend out and we could get well above that position, we would do that.
You're not a technician, is that correct?
No, I'm not.
Do you use technical analysis at all?
Use Bollinger Bands, 2 standard deviations, the price, and that's about it. I look at the fibs.
Do you use fundamental analysis at all?
Not at all.
Do you use any...
One of the beauties about being in the indexes, I don't have to do any fundamental analysis.
Something that you told me once that I found fascinating, you don't look at delta.
No. I like the strategy of delta neutral trading, and I've gone to some classes about that, and it's got a lot of merit to it, but it's not, I don't use it for what we do. Don't need to.
Before we get into any adjusting or anything like that, I just want to, I want to, again, focus. You're out 56 days on these puts, and 1 week, 2 weeks, or 3 weeks later, you're already closing those trades and reestablishing the next 56-day cycle. And on the call side, you're out 14 days, and within a few days or a week, whatever it is, you're covering those calls and then reestablishing it, which is what kept you in the game during this crazy bull market in 2013.
You're looking for a generalization. That's a generalization. But I'm always looking, what's the market telling me right now, today? And sometimes we vary from that. But if you want like a basic strategy, that's our basic strategy.
And you would not do those as a single order. Like you would not be doing ratio strangles. You'd be doing the put side and then the call side, both independent of each other, almost like you're 2 separate traders.
But on the puts when the market's going down, the calls when the market's going up. Even in a market at like 2013.
Hold on a second. You just said something pretty important there.
So you're selling into strength.
And you're selling into weakness
That's
when,
exactly
the
right.
market's going
Both
down.
times it's selling into
Right,
strength.
right. You're selling puts.
Right. If it ends up, we may end up with 1,000 positions on the put side and 500 on the call side. I see them completely independently of each other. I never look at, I've got this much on the put side, so I need to balance it out and put this much on the call side. That thought never crosses my mind.
The takeaway.
So you've got to be active all day long, though. I mean,
all day long.
Okay, so it's not like, I don't want to set the expectation of everybody that's listening out there that you just put this on 2 weeks out on the call side one time and 60 days out on the puts 2 times, and you're just setting it, forgetting it, going on vacation and coming back.
Oh, I wish.
The takeaway for most of our viewers is that you're aggressively managing your winners, which is something we learned in 2013, how valuable that was. And the other takeaway is that you're selling into strength, meaning you're selling calls into rallies and you're selling puts into sell-offs, which is what we call selling into strength. And you are creating a ridiculous number of occurrences, but given the size of your portfolio, that makes sense.
Yeah, we work under portfolio margining, which helps us. We have a large amount of money. And that's funny to me because when I started this, I never would have dreamed this would have happened. Never in a million years. Just started managing a small amount of money, and it just
You're the SuperTrader. Tony,
That's why you got the name and he doesn't.
Tony he's here. He just wants to hear me say naked put.
That's just naked.
We brought up a couple of different pictures of based on what you told us. First, we're going to bring up the TOS platform for a second. And this is the analysis page. And a lot of people have asked, how do you set this page up? In fact, it was an email that we've got. We got extraordinary number of emails over the last year on how you set that up. So what we did is we took one call that was just about one standard deviation out of the money and 2 puts, and we set the screen up. I know it's going to be hard for you to read it from all the way over here, but
that's the February 1850 call, which is 1 standard deviation away, and you're doing that 1 time, and this is all in the SPX, and then you're going to the April options, which is approximately 60 some odd days out, and you're going to the 1630 puts, which would be 2 standard deviations out, and you're collecting approximately $6.25.
So you rounded the numbers. You add those 2 together, Tony, it's $6.25 twice, and then $2 once. That will explain to a lot of people why you made money in 2013, because that is a very long delta. It's a bullish position. Now, what did you do, Karen, to those price slices, and how did you set that up?
I don't know that there is any magic to it. We just use 7 slices. We have on the TOS platform, we are graded by 10% up and 12% down. So those numbers can never exceed our net lick. What we do in 2013, because of what the market was doing in the low VIX, we take the current price, we subtract 100 and take 88% of that. And then we plug that number into that pie slice down at the bottom, and we pretend, that's the best way I can describe it, as if the market has already dropped. Because markets don't crash up except in 2013. They crash down. So our risk level is truly to the downside. So we manage it as if it has already dropped that much, and we're watching that lower number against our net lick.
So you're basically, where I put the circle there, that 1512 and change, you're basically saying that, hey, what if the market goes to that point, that P&L, that $24 million, if you're using the type of numbers that you're throwing around, that's what you're looking at as your risk.
Right. The real number is the $12 million.
Correct.
At the 12% down.
At what TOS would
we
look at.
manage it off of the $24 million. That number.
That's your cushion.
That's my cushion.
Your safety.
Your risk management is there.
The risk management is there. In 2011, we were working 200 points off the current price in 88 because of the volatility.
Sure.
I love volatility. So right now with the low, when the volatility was running 11, 12 in 2013, we had to pull that up to 100 points down.
So just to explain it one more time, you take the current price, you subtract 100, and you take 88% of that.
That's the
number.
12% drop off of that number.
Which, Tony, if I can read correctly up
it's
here.
It's 1512.72 is the number that you're looking for. The current price is 1819.
That's right. And then you measure that against your, you measure that risk at that level against your net lick.
Against the net lick.
And
when the volatility comes back up, we'll go back to the 200 down and the 88% of that.
We also have another platform that we just built called Doe, and if you can see it, it's very visual on there. We don't have it set up, but you can see there the same position, the short weekly, the short call, and then the out of the money put, and you can see the bell curve. It's actually log normal, but whatever. And then you can see the...
You're looking at the 2 standard deviation is right here, and I'm just looking at the April options, and then you're 1 standard deviation away on the 1850 call, which 1850 calls would be around 1 standard deviation on the options with about 9 to 11 days.
Looks like the total credit on here is about 1450. It'll be the same, obviously, on both.
Smaller period of time to manage the call, longer period of time to manage the put.
It's remarkably simple, and obviously it's been working unbelievable. Do you ever get nervous about? We trade very similar, except that I like everything you do, except I can't do it without being net short deltas. And I figured out the whole reason why you make so much money is you didn't carry all those net short deltas in 2013.
That's true.
Do you worry, though, about, because a lot of professionals will, if they're going to be short premium, they're going to be short delta. You don't have that on. That negative drag didn't hurt you last year.
No. No, I don't. I don't worry about this. The question comes up to me a lot, and sometimes I think maybe I'm not worrying about something I should worry about. But this is a tried and true for me. I've been doing this since 2008. I truly live under the if it ain't broke, don't fix it. And we managed this well in 2013, obviously because of our returns. I'm always interested in tweaking it, learning something new. We have one person in our group that particularly likes to come up with new ideas, and we always talk it through and work at it. And if I can find something that makes this a little bit better, I'm going to embrace it.
2013 was a year where there was no sell-offs in the market, yet you maintained this 2 puts to 1 call all year long. And you even maintained it, I assume, into January of this year and didn't get hurt on that little sell-off.
No, we were you couldn't hear us shouting when that VIX went up. We loved it. That was me. That was me.
Do you run away when the VIX is 12 or 13? I mean, do you stop trading? I mean, a lot of times we get questions from people saying, I can understand if you're selling volatility when VIX is high and you're ramping up a little bit and you love it. Do you stop when it's 12 or 13 or 11?
No, we were very busy in 2013. And with the point about the theta, when we go out like that, we're looking for opportunities where it moves. We can get a 20, 30, 40. We love it when it's 50%. We close those positions down. So we're not just going out at the 5% level, the 2 standard deviation, and just sitting there and doing nothing. We're actively pulling that profit back, taking that off the table, taking that risk off the table. So there's just a constant flow going on with the positions. And at some point in time, we just say, okay, everything we've got on, like in March, we're just going to leave in there. And we will go into March with a healthy profit already built up in March. And we'll stop that pullback. We'll go into April and start putting positions on in April and pulling those back and taking the profits off of them.
It's very few traders, very few managers think that way because it seems like an extra step.
Who cares? We're making money.
I don't. You're right. You're right. I just, at what the next big subject is. Okay, so you have this position on, you're short 2 puts, you're short 1 call, you have your perfect position on, and now all of a sudden, obviously we can see how well it works to the upside because there's almost, the markets don't crash up. They can go up, but they don't crash up.
In 2013, I think it crashed up.
Okay, but it worked because you had basically
the volatility contracted.
Yeah, volatility contracts. That really works for you.
Your short-term options. I don't mean to interrupt you, Thomas. Your short-term options that have, let's say, a week to go, and the market's been rallying up for the last 5 or 7 days, and you can certainly see the market going up 5 or 7 days in a row. You then take those options off and move them to the following week and leave your puts in March?
We move them if we have to. I always want as many positions to close out in the current week as I can. We make more money by not over trading. When we're in the current period, I want to see those things expire. I want them to go away. And then that frees up, on our Analyze tab, frees up plenty of room for us to go out the next 14 days and be putting positions on, and we just make more money doing it that way.
So the market starts to reverse a little bit, and it starts to go down. And all of a sudden, your 5 delta puts, both of them, 2 of them, go to 10 deltas. Do you make an adjustment?
No.
Your 5 delta puts go to 15 deltas. Do you make an adjustment?
No. Keep going.
Your 5 delta puts go to 20 deltas. Do you make an adjustment?
No.
So where do you make an adjustment?
I'm
30.
At 30. So your 5 delta.
I'm not going to ask anymore, how does Daddy do it? I'm going to ask, how does Karen do it?
Your 5 delta puts have now gone to 30 deltas. Now they've got teeth. What's the Karen move?
When that happens, and that's just I could say that's an arbitrary number, but I do not want a position going in the money. When you get a position in the money, then you got a lot of other trouble.
Got headaches. Yeah.
That's what keeps me up at night, is something going in the money. So, in a normal course of the day, if it gets up to 30 delta, there are a couple of questions. These are not hard and fast rules. If it's Friday and they're going to expire in 2 hours, I leave them alone.
No, forget about that. But let's talk about 30 delta with a month and a half left to go.
I move the position. It wouldn't be a month and a half. It'd be in the current month.
Okay, in the current month.
I'm going to move the position. We keep enough capital available. That's why we don't on the analyze tab.
What does that mean? Move the position.
We're going to, if it's a put, we take the put off. Then we will either place another put further away from the money, get back down to maybe a 20 probability delta.
Yeah.
And maybe we lose $1 or $2 on that trade, putting it in a safer position. We will
Because
usually
you go
make
out
that
another
up.
month or so?
No, we never go out in another month. We might go out another week.
Okay.
We either are going to try to fix it in the current week because, again, I want those things to expire. I want to get the contracts off. Or we push it out another week, and that's where the weeklies have come in so handy for us. We push it out another week, put it in a safer position, and we will make up that money somehow, either increase the number of contracts cautiously or put some contracts on it.
You mean sell more puts?
Sell more puts.
Okay.
Or let's say it's 500 contracts.
Right.
We may drop it 10 points into the next week, sell some more puts down another 15 points, and make up the difference on the call side. It's a mathematical game we play.
Assuming that you play the markets are symmetrical game that we play, would you also roll the call side? Would you push the call side down? We call it the untested side. Do you take the untested side and push it down?
No.
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 So what are you going to do with the calls then? Because now the calls are cheap. They're 1 delta. Now what do you do?
They're either going to expire or we'll put new call plays out another 2 weeks.
So you don't look at the call.
We manage them. We manage the sides independently.
So you don't look at that call as an adjustment to that put.
No.
Wow.
No.
That's something we
maybe
definitely
I should.
don't do
Maybe
that.
I'll go back and start looking at that.
Well,
At least
well,
let
I
it
don't
cross
know.
my mind.
No, please, don't change it.
I don't want to be responsible.
Well, Tom told me to do this.
Okay, so it's all very fascinating because we would definitely. You will never run into a situation which we get into, which is actually having our position sometimes inverted. Like
that's a no-no.
Why is it a no-no?
Oh, we talk about one of our traders is always saying we want to be this, we don't want to be this. So
we don't want to be that, but we get that way. It's not intentional.
No, we just don't let that happen to get inverted. Because, my goodness, just think of what would happen if.
How do you stay disciplined enough not to want higher implied volatility? Like, in other words, when there are different situations, special situations with lots of liquidity, Apple may be an example, Google may be an example, other stocks with lots of liquidity that afford you extremely high IV percentile, IV rank, just high implied volatility as a way to escape from the S&P 500 low volatility at some points, just because it's exciting. How do you stay away from that?
I often say in the hare and tortoise race, I'm the tortoise. We're the tortoise. It's I don't want to be guessing. I don't want to pick Apple and watch it. I owned Apple the day Steve Jobs announced he had cancer. I learned a lot about trading that day, and I've gradually wanted to move away from that. I don't want to be out trying to pick the next big winner or hit Google just at the time that it peaks out and turns over. It's just, to me, that's risky.
You mentioned in your last interview with us that trading was a game. And you and I know you've kind of gamified it in your own way, but what are the components? Because this is a great question. What are the components of that game? Like who are you playing against?
Oh, myself. It's 2 components. It's money management and risk management. And I think part of our success is just simplifying it. Not getting rid of a lot of the graphs. Oh my gosh, when I first started, I'd have a screen with 12 graphs up, and I was following this this and that and momentum and it was just, I made it as complex as I could make it. The simpler we made it, the more profitable we became.
We've listened to you talk about managing trades. We've listened to you talk about kind of now number of occurrences. And we've listened to you talk about implied volatility. These are things that are kind of the core, the foundation of what we talk about every day. And we've also listened to you talk about some of the things that aren't important to you. Are there other considerations like what the market's doing? Like, do you sit here tonight and go, like I sit here tonight and go to Tony, I can't believe the market's at 1819 the S&Ps.
And you guys took me down back.
And you took me down. Like
Do you ever blame anybody else?
I don't.
A 6-member team. Do you ever blame them?
Do you ever blame me or Tony?
Well, we do have one person on the team that's responsible for either making the market go up or making the market go away. I said, now, I'm leaving for lunch. You are responsible. I wish the market would come down, but I have to play what's in front of me. I just have to play what's in front of me. And it's such a contrarian. I feel almost un-American when I say, gee, I hope the market drops today. Because I know everybody else wants it to go up, but I don't. I want the volatility to go up. It's more fun to have volatility. We can work our strategy so much better. And
doesn't matter what direction the market's going.
Doesn't matter. As long as the volatility is up.
That's what I'm saying,
if it's going up, volatility is going to be down. And
do you find yourself? Do you tell your team that there's a direct correlation between the number of trades you make, your level of activity, and your fund's results?
We don't talk about that per se, but the level of activity ties into our Analyze tab. We just literally make our decisions based on that Analyze tab. So as we're pulling positions off, it's easing up on the Analyze tab. We're putting more positions on. And yes, that level of activity makes a difference in our results. Do
you recognize the level of your success? Because this is something that you're from a school, a background that's very similar to most of the do-it-yourself investors. Yet you've achieved a level of, if we're going to measure by just dollars made, numbers that 99% of most professionals never get to at any level. Does that? What does that do?
I don't think about it. And in my mind, we won't go into the depth of this, but it's not the what I do; it's the why I do it, and that's my motivation. What a privilege it is to be a part of this, to just have this as a part of my life. I'm grateful every morning when I wake up that I get to do this.
You love coming to work every day.
I love it.
What's the first thing you do in the morning?
First thing I do in the morning?
Yeah.
I check what you've said on your email, and I look at CNBC and see where the market is, and see what the overnight market, what the Europe and Asia markets did. Does your firm, do you research, do you do a lot of, is your stuff real, is your business real time, or is there a lot of research that goes into kind of studying the way you generate your results? In other words, do you commit a lot of resources and capital to researching kind of your program, or are you doing it all kind of real time on the fly? We did at first. I spent hours and hours and evenings and Saturdays and Sundays, and where we've brought it to now, we're doing it on the fly. It's the energy in that room. We have exceptional traders. They know what to do. We disagree with each other from time to time, and to me, that's when it's at the best, because you get new ideas. It can get a little stale every once in a while, and I love it when somebody one of the guys will challenge us, and we have to think about some things a different way. And we test. We may pick up something that you say. We may get some idea, and we'll test it with just a small number of contracts, and that's been fun. We've done some risk reversal positions, and one we run one really big on, and one we made a little on. But but again, that's just a little tiny tweaking.
Do you ever tweak with direction? Take a little risk directionally?
Rarely.
Rarely. Wow.
I just don't want to go down that road because my crystal ball cracked and it's in the shop and they haven't fixed it yet, and I don't want to be doing that. Now in 2013, just the methodology that we're using, the 2-to-1 ratio and all that came from the direction. If
I am a struggling young trader, like a Tony Batista, if I'm somebody that's been
I feel like the third wheel on a date over here. I'm not gonna lie, this is a new position for me. You're probably more comfortable with this position.
Let's say I've been trading for a couple of years, and let's say I've done the time, and I've read the books, I've watched the videos, I've traded, I've paper traded, I've traded lots and lots of 1 lots and 5 lots and 10 lots, and I've really committed, maybe not the quote 10,000 hours, but I've committed 3,000, 4,000, whatever it took. I understand how hard this is, and I'm not getting over the hump. What do you tell that person?
I really, that question really doesn't come up to me. First of all, how much money you have to trade. It's a whole different world if you're trading $5,000 than if you're trading $300,000.
Right. Well, most people understand the linear part of that. Right.
A whole different world.
Right.
Portfolio margining helps me. I would keep looking for what you do best, because this works for me doesn't mean it's going to be your cup of tea. It doesn't mean it'll work for you. You have to find what is right for you. I don't trade bonds, and I know people who make money off trading bonds. I don't trade Forex, and there are people who make money off Forex. There are people who make money off calendars at certain times of the year. I found what works for me, and I would just encourage people to find what works for you. Don't try to duplicate what I'm doing. Find what works for you. What is your risk level? What's your money management?
But assuming your risk, assuming that everybody's, you define undefined risk as 2 standard deviations. That's your sleep. That's what makes you sleep at night. 2 standard deviations. So assume that. Okay, I love that thought process, because I have the same thing. I assume undefined risk is 2 standard deviations. But how do you tell somebody that's, again, trying to get, they understand that they're very limited sometimes by capital, but how did you get from, you were limited by capital too.
Right.
How did you get from being limited by capital to that next step?
When I started, when I got past the covered call stage, I was trading iron condors.
Okay.
Just went down that, and I'd leg into them. And I was using a 15 delta. So when the market would go down, I'd put on the put side, and the market go up, I'd put on the call side. I was looking at the profit I was making, and back then I was still selecting stocks. As I kept studying that, I thought, I can take off the long side. And again, stepping back and looking at the big picture, there are times that I would just roll the long side of that forward and let the short side expire. I stopped seeing things as all tied together. Each play, if you put on a strangle, a straddle, an iron con, you can look at each piece of that as an individual piece. And I started looking at, I could make the same money off of that buy-sell trade, go to the 5% out of the money on the put side, and make that same spread that I was making. So that's when we went naked.
I love it.
I get all that, but you would never do anything in the markets where you didn't have what you thought was a probability type of edge. Like, you're not going to do something. You're not going to go out and buy a 20 delta call, are you?
No.
Right.
No.
Never.
No, never. No, never. What I like about the selling premium, if you are buying calls, buying puts, you can only win if the market goes one way. And it has to go that direction significantly to overcome the theta decay. I can sell premium and make money if the market goes up, goes down, goes sideways. Why wouldn't I choose to trade that way? One way I can only, in the long premiums, I can only make money one way. The selling premium, I can make money 3 ways. It made sense to me. Why wouldn't I just go to selling premium and forget about buying calls, buying puts?
One of the questions that comes to Tony and myself all the time about you, and I agree with that, by the way, because that's the same exact way we trade. It's exactly the same way we trade. But one of the questions that comes to us all the time is, it has to do with how you manage risk. Now, we talked a little bit about, okay, what happens when the 5 delta option goes to 10 deltas. But now the next question that comes to us all the time is, what happens when your position starts to just lose money? So one day your net lick is $100, and the next day your net lick is $80. So the options didn't explode, but you just lost, $20. What do you do?
And it's very frequent that in those unrealized positions we're losing money. That if the market's moving in any direction, but the positions themselves, in my mind, are perfectly safe. So we're managing off the analyze tab. Worst case, I'd buy some low-valued puts. I would buy some calls, just offset that push that we're getting from the market move. We don't have to do that very often.
I was going to say,
if the position's losing money, I don't care as long as the position itself is still safe.
So you really don't over-manage your positions at all?
Try not to. Only when they need our attention.
You stick to the discipline. If you don't get through that level, you're not going to make an adjustment.
No.
And you're never going to move down the other side to adjust that position either.
No, because what if the market turned on me and now I've taken a perfectly safe position and put more risk to it? I would rather a position expire and free up that space so I can go out and sell some more.
Do you ever look at it as a percentage of gain on just take the $100 that Tom just threw out there? Do you say, if I get to a 50% gain or a 25% gain or a 90% gain, do I look to take it off?
When it's in the next month.
So you're talking about your 2 puts in March. Month. Got it. So the front month you're pretty much actively trading, and that back month you look at it as that's my annuity that's going to be coming in the next 60 some months.
That's a good word. Yeah. Yes.
See why I'm here.
Yeah. That's.
Do you think? Okay, so since we've traded for so long and we understand kind of some of the, we understand how hard it is to make a lot of money. To make a little bit of money, when you stay small, I think it's reasonable to assume you can pull it off. To make a lot of money, man, it's hard. 50 million, 70 million, 90 million, whatever you've made over just the last year, those are, again, I'm going to get back to this because it fascinates me. Those are crazy-like numbers without the. I know you've maintained a little bit of long delta. Can you do this into perpetuity? Meaning that, are you confident you wake up next month? Obviously you are, but I mean, what drives you? Is it the game part of it? Is it the game itself? Is it the love of the game? Is it just that you think that there's this mathematical, you can see that mathematical equation? What did we call it the other day when big fat pitches?
Big fat pitches.
Big fat pitches. So everything looks does everything look like a watermelon to you coming across the plate?
Well, I have to think about that. It's the confidence. I have a high level of confidence in what we do because it's proven, and we've done it over and over and over and over and over. It's like, go to the start batting practice and hit the ball. You're going to be better if you hit it 500 times than if you hit it 10 times. And I've just got a high level of confidence, and you know the why. So what motivates me to do this every day? It's a means to the end. It's the why. It's the charity. But what we do with the charity.
Right, and we're going to get to that, and we're going to get into your whole charitable thing in just about 2 minutes, 3 minutes, because I can't wait to talk about that too. Because I mean the complexity of, maybe it's the simplicity. Maybe I'm thinking it's all complex, and maybe it's just the simplicity of it. Because maybe we make more out of it. What I love about
it's keep it simple, Sosnof.
Yeah. What I love about
He's always overcutting. You love that. See, let me talk to Karen for a little while over here. Okay.
I like that.
I tried to cover how you adjust your risk. Tried to cover how you manage your winners. And when I say adjust your risk, you're really all just about managing your winners. That's pretty much your whole business.
And
Put on lots of
staying
trades.
out of trouble.
Yeah. By managing your winners. You put on trades with 56 days to go, and you're taking them off by the time they have 40 days to go. And then you're just constantly you're in that part of the decay curve that is steepest.
Yeah, I love that. I love that curve.
How the hell did you figure this out? Nobody else did.
I don't know. I just studied it and studied it and studied it, and it just made logical sense to me. I'm an accountant. For goodness gracious. It made sense to me. The numbers made sense to me.
So let's take it a step further. You keep talking about this mission.
Watch me light up.
I am watching you light up. You talk about this mission, and you love coming to work because you give away most of the money that you make. Tell me about it.
Well, the public fund that we've been talking to, 27.5%. It outside of paying expenses, it's all. I've gifted my ownership of that company to our foundation, which right now we're working in Africa. So
last time you were on the show, you talked about building, water purification systems, and now I heard you're really getting into you built a plantation.
Pineapple plantation.
A pineapple plantation.
Yes.
What do you know about pineapples?
I know nothing. Isn't that fun?
Huh?
That's the exciting part. I know nothing about pineapples. So I'm over in Africa in November on the ground digging with my hands, planting pineapple suckers. I was thrilled.
We brought one of your business partners with us because we wanted to talk just a little bit about it. We didn't want to put you on the spot telling how great you are. Tony can talk about how great he is.
Yes, it's
or how great I am, but we don't want you to talk about how great you are.
Usually Tom says something to me like, hey, Bat, tell him how great I am. And then I have to go on to, it's a contractual thing.
But you've got notes over
That's
there.
correct. I do.
Without getting into the background, I just want people to understand what you do. It's just it's off the charts. I think we called this kind of impact investing. Jay, are you there?
Here.
Sure
Yep.
is.
Hey, Jay, how are you?
Doing great.
Oh, good. We can see on the screen right here. So you're a business partner of Karen's, and you're managing director, and you work with her, and you've been to Africa with her. What's going on? What are you guys doing?
It's incredible. It's we all talk about Karen as a super trader, and I've been taking copious notes over the last hours listening to you guys, but she really is. She's a super person, and I think that's something that, frankly, your listeners should learn more about. Karen is, I would characterize her as really an ambassador for conscious capitalism. She's gone out and taken the best practices of trading and capitalism. And sure, she does a super job with returning, getting a good return for her investors. But a portion of that she's allocating to essentially spreading the best practices of capitalism around the world. So she realizes that it's better to go out and give a portion of the population a hand up instead of a hand out. And it truly is. It's remarkable how it's working, and it's remarkable to see that her commitment is paying off around the world.
You mentioned earlier. You called it performance with a purpose.
Right.
I love that term.
Oh, it's great.
It's conscious capitalism. Tony, conscious capitalism, by the way, is not you driving a gypsy cab in Brooklyn, by the way.
I was just going to are you kidding me?
You probably didn't know that, Jay. But you went over to Africa. You guys built it with the proceeds from the funds, which is just, this is where you differ from most traders, okay? The proceeds from the funds go into a Lamborghini. The proceeds from the funds went to a pineapple foundation, a pineapple plantation and everything else. Talk about it, Jay. Just what was it like?
Incredible. So I think you went through the math briefly, but if the firm returns, say, $10 million, $8 million gets returned to the investors, and we're all very happy about that. But about $1 million of it goes to cover some of our overhead, and about $1 million goes into a foundation, which Karen manages. And she finds places like Sierra Leone that are on the very bottom of the Human Development Index. And she goes over and she gets on the ground. She's boots on the ground, gets engaged with the people there, finds out what they need, and figures out the best way to essentially provide opportunities. So it's a protracted effort. It's not something where we go in and just either try to give people a solution for a day or a meal for a day or for a week, but really give people the opportunity to pull themselves up and be successful over time.
Did you actually plant a pineapple?
I did.
I witnessed it, yeah. She got her hands dirty.
And he did too.
He did too.
We were all on our knees planting pineapples. We've got 100,000 pineapples planted.
100,000.
You call yourself a human being. You should be ashamed of yourself.
I am ashamed of myself.
I'm ashamed for you.
Jay, it must be amazing at this point. I mean, I know you trade as well, and because I've met you in the past, and it's it just must be kind of a fascinating transition for you just to witness this whole thing. I mean, it must be cool as it could be.
It's incredible. It really is. It's such a rewarding experience to be able to go to work and sure maximize shareholder value, but also have a larger purpose. The performance, a purpose with the performance is a wonderful thing that gets you out of the bed in the morning. By the way, Karen likes to have Diet Coke to get out of the bed in the morning too. That's another thing.
It's okay. My friend over there likes a croissant. It's okay.
Jay, thank you so much.
Thank you.
Thanks. That was great.
Jay.
That was really good, and I'm glad that he came up here and just to talk about, because I know you won't talk about yourself, but that the whole idea of not as the conscious capitalism I get, but the impact investing. We have an impact engine incubator here in Chicago, and I mentioned that to you. It's just kind of incredible. We are focusing right now on a new demographic. Ages, the millennials and everything else, ages 21 to 35. We're building technology for them. We're building a network for that demographic. We're building software for that demographic. How much different is the world in financial literacy and investing going to be if we're able to imagine if you were 21 and all of a sudden you had all these crazy tools. Would you have had gone for the same degree? I don't know. I mean, I'm just curious. What are you thinking?
That's. I try not to even think about if I knew then what I know now. Especially for women, getting more women. I'm on the board of directors of an organization their focus is to get girls in school interested in finance as careers. So I'm seeing that organization is doing a phenomenal job. You know more than you have a daughter involved in this. You know more about what the next generation's learning and the tools that are accessible to them. And I'm watching it. I'm watching it. That I got started so late in life.
Yeah, but I'm watching it. Kind of that whole generation explode. What if we could say something as we leave our viewers, or as we wait to the next session. If you could give just a couple of kind of bullet points, just a couple of heads up. Hey, here's something to look for in 2014. Here's something I'm doing. Like just a couple of focus points. Something somebody could. I love takeaways.
Wow. Well, in 2014, for me, I just want the volatility to go up. I would encourage people to. I'd say look at the big picture. I love what you're doing. If you've got to trade by yourself, then they should be involved with your program and do it as a group. Get some other input into what you're doing.
If volatility does expand, which is likely in 2014 after 2013 was so low, what would you challenge people to test strategically? Like if you're just kind of on the fence, and you're just getting involved for the first time, how would you challenge them strategically? Like what would you say to somebody like, hey, you know what, do this one lot, try this out, or like what would you say?
I am a proponent of the non-directional trading. I would just say stop trying to think you know which way the market's going to go. I've been bruised by doing that too many times. Go to a non-directional and try. You got paper trading. Find out what works for you. If I had a small amount of money, I'm still a proponent of the iron condor and trading on both sides and legging into it.
You are the super trader because you figured out on your own how to define undefined risk when the companies that were teaching you and everybody else couldn't explain undefined risk. You figured out how to define undefined risk.
I figured out what to do that I'm comfortable with it. And the Analyze tab, to me, is a very powerful tool. And I we use all of our traders in our room are just living by that analyze tab. So we know exactly the idea of also pretending like the market's already dropped, and then we're managing that 12% down from that drop. When people say, "Oh, it's just too risky," I don't see that as risk. I see that as managing. Our job is to manage our trading, and that's the way we manage it. And to me, that's managing our risk, not being, not having an unhealthy risk level. We're intelligently managing it. So I'm comfortable with it.
Listen, I think it's been a great interview, and I think on behalf of everybody who's out there listening, you've been inspirational, and I'm in awe of you, so thank you so much. I do have one bone to pick with you. And please don't make that face, but you said one thing that's going to probably stick with me for the rest of my life, and I'll have to play penance for it forever. You said that the first thing you do when you wake up in the morning is you read Tom's Cherry Bomb email.
I do.
Now, he is going to say to me for the rest of my life, Bat, did you hear what she said? She reads my email first. When she wakes up.
The first thing I read. I've had to work at understanding what a quacking duck meant, but I'm getting there.
Have you got the barking ducks down?
I'll have half of it down.
Thanks so much, Karen. That was great.
Thank you.
Thank you.
Pleasure to be here.
Thank you so much, Karen, for your time.
Thank
Really
you.
appreciate everybody out there listening to us. Thank you so much on behalf of Tasty Trade. Have a great night.
No matter where
Special guest. Moment I've been waiting for.
Thank God. It's not just you and me. Karen, how are you?
I am doing great. It's so good to see both of you.
You can't just call her by a first name.
Yeah.
Karen the SuperTrader.
I'm sorry,
No,
Karen the SuperTrader.
Karen is fine. Karen is lovely.
Did you ever know growing up that you would be referred to on the streets, hey, it's the SuperTrader?
No, I must give you credit for giving me my 15 minutes of fame in my life, as I was just at the Invest Tools conference in Dallas.
Oh my God, they
Flew
must
here from there.
You're going to be bigger than T. Boone Pickens down there.
It's so strange.
Yeah.
I got my picture taken with T. Boone. I went, when I stood next to him, I said, "Thank you for putting up with this." He said, "Oh, they're paying me." So, well, then.
Hold on, I didn't even know you were going. Oh my God, you must have been like the queen of the castle.
It was interesting. I've
Oh
never
my
quite experienced
God.
something like that in my life, but I did bring the conference manual with me, and I noticed as I went through it a picture of you in it.
And the
With
conference
a
manual?
quote, "You know you're a trader when you're wrong and you still make money." So I thought,
What's that
then
quote again? I need to know that
I
quote.
am a real trader because I'm wrong a lot and I still make money. So
Yeah, but I'm wrong a lot too, and I'm not making any money right now. So help me, you guys.
Okay.
I'm going to be taking less than you. I didn't even know you were there, and I'm sure that a lot of people that made their whole trip.
well, I won't speak for them, but it was interesting and it's different to
carry
be
you around on their
recognized.
shoulders?
It's
To steer you?
really strange. No,
Okay.
very nice people.
Oh, man.
really humbling to meet people who recognize me. But thanks to you for what you've done for all those traders. They all know you. So
Yeah, that's
great.
fun, but that's just because we're just loud and obnoxious sometimes. That's all.
Number of occurrences
Yeah,
for
number
us
of
is what it
occurrences.
is. Yes.
We're in front of so many people every single day that it just eventually it seeps down through.
Look at what you've created. You've created this
monster
from scratch.
A monster. Yeah.
Yeah,
He tells me
monster.
every day, "I made you, Bat, and I can destroy you." So yes, thank you so
Anyway,
much.
Karen, we are so we didn't even talk about this week because we didn't want to. We wanted to have some fun today.
Yeah, well, I'm
And-
just stopping by to say hi. So
I know.
There's
That's why
nothing
we stole you.
formal
We just
here.
grabbed her basically off the street, and we got a bunch of question stuff. But something that just so everybody knows. So Karen's really like we tried to preface this before you're even on. So we were talking about you before you even know what we were saying, and I said I'm not even sure how to classify Karen. Tony, I mean, it's like we've had trouble just putting you in the right bucket, as Christy would say, because you're an accountant too. So
Yes.
Christy and you bucketize accountants bucketize everything.
do.
And you have to
Yes.
find us. It's that tick and tie thing. You have to find out where you.
Yes, details are wonderful.
So you told me this year. First of all, how much money are you managing? Approximately.
It's
You don't have to be
moving
exact.
toward 300 million.
Moving towards 300 million. And they're up 11% this year, which is remarkable
July.
because I think
It's
it's a
amazing.
really tough year. And if you know, I don't know if you know this, but the hedge fund average this year is 0 after fees.
I've read that in the Wall
Yes.
Street Journal.
Yes. And so you're 11%.
At 11.5 after expenses. That's net to our investors.
That's amazing.
It's amazing.
And you said something else. You're approaching a milestone of $100 million in profits.
Profit.
Now, I would love to take you and put you in front of a Senate subcommittee so that they can actually see.
Please.
I know you're going to have a
Retail investor,
You're going to have a
right?
heart attack. But I really need somebody that's made $100 million on a retail platform that any person can have using the strategies that where everybody says it can't be done because the only way that people can make money is essentially through some high frequency mechanism. You are an amazing story, and if I sound like I'm putting you on a pedestal, it really is because we're still fascinated, and we're in the middle of
Well,
fire
why don't
every
you
single
come
day.
to see me then, and I'll show you. You can sit in my trading room with me.
I would pay for that to happen.
I don't know.
You
I
just
don't,
can't say where I live. So
I don't know if I'm enough of a man to handle that. I can't even use my own GPS system. I'm not really sure I can handle it. But yeah, we would have to broadcast from there. That's the problem.
Yeah,
I'm not sure that's so cool. But someday we need to. Karen, I've been saving questions, and all along we've protected privacy. We try to get nowhere outside of what we just talked about. But so many people are fascinated by what you do. But the number one question that comes into us all the time, and we're fielding Karen. Talking about Karen is part of our everyday. We just throw it in there as like you become almost a verb.
That's true.
You're like a trading verb.
Okay.
Someday they're going to write trading books. A straddle, a strangle, Karen. That's going to be. The question that always comes, the question that people ask Tony and I all the time is, in order to do what you do in the products that you use, which is primarily the S&P 500 indices.
it's broad-based indexes.
Yes. To do what you do means that no matter how you slice it up, you have to take an extraordinary amount of risk at times. And when you have this kind of risk on and volatility is cheap, and we all know that volatility is mean reverting. How do you deal with both the real risk and then kind of the emotional consequence of that risk, meaning having to think about it all the time?
Well, I think about it all the time. I hate where we are in the market. I've hated where we've been in the market for over 2 years. This VIX below 12 is just very difficult. It's interesting that the most difficult times for me to trade is in an environment like this.
So going into it, would you have thought that volatility, like when you first started years ago, that if volatility was nice and low and the market, that would mean there was little movement in the market, that would be the best strategy for you?
No, I've never felt that way. This potential of a strong pullback, I think that's real. So we have to be very cautious on the downside.
Right. So what do you do? Like specifically, how do you deal with that? Your positions. Assume you're delta neutral. Okay. So you don't have to say you're long or whatever it is. Assume you're delta neutral. You still have a lot of outlier risk. How do you deal with the outlier risk?
On the again, the difficult side is on the call side. On the put side, we look for those wonderful opportunities like the last day of July when the market fell strongly. We were just throwing on puts.
Short puts, when you say it.
Yes, short puts.
Yeah.
As much as we could. But we're trying
Is that
to
because
stay.
you didn't have inventory already and you're waiting for a day like that?
Waiting.
Okay.
We wait for those pullbacks, to put on puts when the market's high. We can't get far enough away where we feel safe with it. In this environment, what I like to do is stay 200 points away on the put side. This environment just does not make the money decent enough to go 200 points away. So we've been pulling up to about 150 on certain days, depending on what the market's doing. We'll be trading 100 points down on the put side.
200 points. I want to just make sure everybody understands. 200 points away is a 10% move in the market. Okay.
I am looking for a 10% pullback, but my crystal ball is not better than anyone else. But we also use our Analyze tab. We're ThinkOrSwim traders. We also use our Analyze tab and look at the market we trade as if the market has already fallen at least 100 points, and then we go 12% down below that. So we've almost got a 17% down move on that we could
because 100 points is 5%,
sustain,
and then you go 12% beyond that.
That we could sustain if we had to. I don't want to see that happening, and if that did happen, we would be moving positions like crazy to get into a safer environment. We also have an overall goal of only using about 50% of our investable assets and keeping about 50% of cash on the side. And depending on the variables, where are we in the market? When are positions going to expire? We'll inch that up to 60 or 70% use of the cash. But overall strategy is to stay with about 50% of the cash.
Are you still entering trades with about 55 days to go? And are you still trying to roll those profits at the first kind of, whether it's 15, 20, 25%? Are you still being aggressive in that regard, even in this low volatility environment?
We do start around 52 days. We will roll in the weeklies, but the way we account for our gains to our investors, we don't roll from month to month. We let each month stand on its own. So in the month of August, we will not roll anything from August into September. If I was trading my personal account, I would definitely roll to the next month if I was in trouble.
That's just a function of, because you're a professional money manager, and it's harder for you to manage, I'm assuming, new monies and where your start point is.
Yes, it is.
Okay. Yeah.
And speaking of weeklies, in Dallas, you were mentioned from the stage of being one of the people who helped get weeklies started
we were
in the market.
People.
But they also said you had a different name for weeklies. You wanted to call them a quickie.
It's true. It's a true story.
So that got a big laugh at the conference.
The exchange didn't like it, but it's actually a true story. It was Tom Preston and myself.
Yeah.
So do you use futures at all now?
We do. We've always used futures.
Right.
I have a trading strategy that I developed where we speculate with futures, but we also hedge with futures. We're carrying short futures.
How much
right now.
of your positions are hedged with futures, and how much of your positions, or how much of your capital do you use to speculate with futures? And is the reason that you speculate just to improve basis?
It varies all over the place. You've got to look at the variables, where the market is, where's the expiration, what are we seeing, what are the charts telling us. We keep that on a lower side. The speculation is a small portion of our portfolio.
That's just part of your market
I don't
awareness.
want to be out there rocking and rolling.
Yeah.
But we have a very successful future strategy that we have the confidence in playing, but we still keep that a low part of our portfolio.
So how much of your futures trading goes into hedging? Most of it? And how much of the big picture is that? Because that's the thing that confuses people. Like, how much capital should they commit to, to something like using futures as an offset to some of the option positions?
Well, of course, that depends a lot on how much capital you have. The smaller you have, the less you should be dealing with futures.
Yeah.
We'll probably use 20-25% at any given time to hedge.
So, Karen, one question that comes in that we get a lot is, so with volatility lower, and I think you started to talk about this before, but with volatility below some historical mean, then do you look at your net lick and your total capital committed differently when volatility is cheaper? Like, how do you make that adjustment? Like right now with volatility cheap, how do you adjust the size of your positions, total capital committed versus your net lick?
The strategy stays pretty much the same. We just make less money. We have come up higher on the put side as far as the strikes that we'll sell at. Depending, again, on the length of time we have to stay in that position. But the overall strategy stays similar. That's why in 2011, we were making a 50% return. In 2014, we're making an 11% return. That all comes down to the volatility.
You mentioned before that you were a little nervous about your call side. and because your call side is actually closer to the money than your put side.
right.
But the call side seems to give you there's less of a undefined risk on the call side. Is that the way you would think about it, or no?
No, actually, the calls with this slow creep up. I mean, it's very, very difficult. I don't like calls. I don't like calls at all.
Neither do we.
But we don't. I don't want to leave money sitting there on the table either. So we do play. We try to get as far out as we can on the call side, and we're making $1 per contract and trying to keep those positions safe. We have enough capital. We've got enough cash sitting on the sidelines that very often we're having to take the call positions off, roll them forward if we can roll in the weeklies, or just moving them over to the put side, and that's kept us
Getting
quite
back
active.
to the to the question that a lot of people hit us with, if there was an outlier event, and we're not talking about a 5 or 7 or 10% move in a short period of time, we're talking about maybe a 20% move or a 25% move in a short period of time, which would probably be to the downside, not the upside. In the unlikely event of that happening, because we haven't seen anything like that for a while, there would be the first thing that would happen is portfolio margin and margins for futures and everything else would obviously go up, and there might be some more chaotic quotes in markets and things like that. How would you deal with it? Are you just saying like, hey, we're prepared for that because we've stressed our positions down to like down 25% and down 30%, or how does Karen deal with that?
I didn't live through the October 1987 crash. I did trade through the flash crash of 2010, the slam dance of 2011.
That's what you call it, the slam dance of 2007. Tony calls that the flash dance.
The flash dance. It's funny you ask that question because I'm right now involved in a very healthy discussion about what we can do to protect ourselves. There are triggers in the market that weren't there in 1987.
You mean
so
there are
we shouldn't be able
breakers.
to. There are circuit breakers.
Yes.
We shouldn't experience a 20% drop in a day, but a 10%. A 10% drop, a 15% drop, we could handle based on our just current strategy that we're using. I want to make that safer. So I don't have an answer yet of what we're going to be doing, but I want to make that stronger. We're pulling back and doing a very in-depth analysis of that potential risk and what we can do to make ourselves safer. I've got a meeting at ThinkOrSwim when we finish this, and it's going to be focused for a couple of hours on that question.
Karen,
how we can be safer.
To piggyback a little bit on that, not the outlier move, but just on your overall mechanical strategy. You talked about in the last videos how around, if an option becomes around a 30 delta, you look to roll it. Is that kind of like a hard rule for you? Like it doesn't matter amount of time left to expiration or anything like that? Do you just roll it when it's that 30-ish delta?
The variables do matter.
They do.
If expiration is today and I'm at a 30 delta
You'll
and I'm
probably let
looking
it
at the
stay.
position, I'll probably let it stay.
Got it.
But if it's 3 or 4 weeks out, then I'm going to pay close attention to it. I don't want to push it to the limits and then be all stressed out about what am I going to do with this position. So I like to go ahead and clean it up. Sometimes I'm right, sometimes I'm wrong. But Tom says I'm a trader anyway, according to his quote, that I can be wrong and still make money.
The simple answer to this big question is that you have to be proactive because there's no way you can be reactive into that huge decline if it ever happens. So the way to be proactive about it is potentially to always maintain a short delta on some portion of the portfolio, which is then costly if you continue to grind up. But the other side to that is that's how you protect yourself. 20% down, it may get you to 25%.
Right. It helps take the emotion out of it too.
Yeah, sure.
I don't want. I'm fortunate in that greed is not part of my personality, but neither is fear because over my learning period,
Nobody
training
ever accused
period,
you of being fearful.
I've gotten the confidence of knowing what to do in those situations. But that came with a lot of hard work and a lot of time. But being proactive, I love that word, it takes the emotion out of it. I don't have to sit there and say, oh my goodness, what's going to happen? Oh my goodness, what am I going to do? Just go ahead and deal with it and fix it and move on. And that's served us well over the years.
That we get that question all the time, Karen. We get, well, why doesn't Karen maintain, which you very well may, why doesn't Karen maintain just a bunch of short deltas, which she's just willing to eat the drag cost, if for nothing else, the carrying cost and the grind cost, but for peace of mind. And I'm thinking, well, that makes the most sense, but I'm not sure, like I've never figured it out how big a drag that really is.
Maybe the next time, if you ever invite me back, then maybe the next time I am exploring and paper trading some new ideas how to make more money on the call side that's just a little more conservative. Because this slow grind up is just absolutely killing me. I don't like dealing with it. Oh, I am in your world.
Boy, I wish it was killing me for an 11% return.
Do you know what's really funny is that the great thing about you is you'll sit here and you'll go, I just came back from an Investals conference and I'm paper trading something, and people are like listening to us going, that's me without the 300 million. It's just like, and it hits home with so many people. It's so the influence, the power, well, really the influence that you have, and it's a good influence. It's a positive influence on so many people. You have no idea what just 15 minutes on the show is worth. It's awesome.
What I loved, so many people ask me about the nonprofit and the work we're doing in Africa, and that thrilled me. That they're getting both sides of the message, because we've got a for-profit and a not-for-profit coming together to make a difference in the world, and that's my passion. That's what
we
I
can
live
barely
for.
handle the for-profit side. The non-profit side just blows us away. We're just not that good. We already had that discussion.
Well, I started trading with a $10,000 account, and I'm just stubborn enough that every time I lost, I said, "All right, I learned something great from that. I won't do that again." And so I built a career out of saying, I won't do that again. And that's what's gotten me to where I am today.
You'll like this. We had a professor here the other day just visiting from Wake Forest, and she's a biologist, and she studies bees. And I said, what about Karen? Because she knew, she doesn't know you, but she knows of you. And she's like, oh, she's my inspiration, and it was really funny because she's like a neuroscientist, and it's really funny the how you've reached into so many people's lives, just because part of it is the social impact side, but the other side is just we're all fascinated. You make it seem, you downplay it like it's nothing, but it's way bigger than nothing, because
anybody who's trading knows how difficult it is.
That's right. It's not putting the position on for the first time. It's putting the positions you put on for the 100th, for the 10,000th time in a row.
Well,
but that's your key to success.
And I've surrounded myself with some very smart people in the office, so I love the brain trust that sits in that office.
That's my problem. I didn't surround myself with smart people.
I was just going to say, when does Tom moonlight at your place? Because he must be leaving all the good stuff there, because he doesn't bring anything.
Can you send some of those smart people up here? I need taking me down. I knew it was all your fault.
Most of those people have been in classes that you've taught. So
this is crazy. It's such a great story. Thank you so much for coming and just giving us 15, 20 minutes. It's awesome. It really does help our entire view best. It's just great. Thanks, Karen.
My pleasure. Thank you.
Thank you, Karen. Your time's valuable. We appreciate it. We're going to be back in about 90 seconds. We got a bootstrapper next. This is Taste Trade Live.